So I believe we are live. If you can, if you can clearly hear my audio video, do let me know in the comment section whether we are live and whether our audio video is clear is not. Yes, sir. We can hear you. Okay, okay, okay. Yes, sir. We are live. So hello everybody and welcome to this English CA Final Direct Taxes and International Taxation Power Batch. I hope you all are doing really, really well. Just let me know in the comment box how you all are doing. See, I am always presuming that you are doing good. But in reality, how you all are doing, just let me know in the comment section. Because I know it is really hard in festival season just to wake up and sit in front of class. It is difficult. But the fact is, whatever the difficulty is, we have to follow. We have to face. We don't have any other choices. So it take real guts to come up in the morning in this festival season and attend a 4 hour class. In itself is a good achievement. It's a big achievement. You must be appreciated for that. Sir, yesterday, we completed all the concepts of the capital gain. I remember two concepts were left. But apart from those two concepts, we completed all the concepts. Since this is not just a concept laden batch, we just don't have to read the concepts only. We have to solve the question answers. I want all of you to practice certain questions with me because there are certain questions which must be followed, which must be solved by you. Can we solve all the questions? Right answer is no, we don't have such time. So for that matter now, I have shared a PDF on my Telegram channel. A PDF which represents the complete chapter, complete syllabus. I have handpicked nearly 124, 128 questions. And those 128 questions are complete representative of the syllabus. Those are 128 handpicked questions. I call them Super 100. Those Super 100 questions must be practiced before going to exam because those happy Raksha Bandhan. Okay, good morning. So those Super 100 questions must be practiced. So I will be taking those Super 100 questions in this batch only. Of that PDF, I am starting with question number 6 because previous question we'll be able to solve later on. I am starting with question number 6. Just have a focus with me. Okay. Whatever we have studied till now, with that logic only we are continuing forward. Whatever we have studied till now, with that logic only we are continuing forward. 4 or 5 questions only we have in capital gain. Once we are done with that, we can continue further with the remaining topics. Okay. Following are the details of the income provided by Mr. Singh assessee for financial year ended 31st March 2025. Simple point it is. Rental income from property at Bangalore 3 lakh. Standard rent 2.5 lakh. Fair rent 2.8 lakh. Oh my god, sir! Standard rent, fair rent, actual rent. We don't know. We don't know chapter house property. We don't remember. Do you also feel the same issue? Do you also face the same issue that we do not remember house property, sir? How will we solve? How we'll be able to solve if something comes beyond the syllabus? Arey Baba, do you really think this is beyond syllabus? This is pure logic. Whatever the municipal rent is, whatever the fair rent is, whatever the standard rent is, sir, that is irrelevant if your actual rent is higher now. These are just the presumptions. Standard rent, fair rent, municipal rent, these are just the presumptions. But if actual rent is higher, only actual rent will be taxable now. Only actual rent will be taxable now. So this is irrelevant. This is complete crap in this case. Our house rental from house property will be 3 lakh only. In reality, how things are taken, see, we have to compare municipal rent with fair rent, whichever is higher. Whatever figure comes out, we have to check for standard rent, whichever is lower. This gives us expected rent. This expected rent has to be compared with actual rent, whichever is higher to be taken. Got this point? Did you get this point? Yes, sir, we got this point. Ultimately, what matters is actual rent. If it is the highest of all, then we have to take actual rent only. And logic also says this thing. Whatever we have, municipal rent, standard rent, if actual rent is higher than that, then government is going to tax the actual rent only, na. So rental from house property will be 3 lakh. Municipal taxes paid for current year 35,000. Municipal taxes paid for arrears 150. Sir, municipal taxes are only allowed in the year in which they are paid. Municipal taxes are only allowed in the year in which they are paid. Sir, whatever municipal taxes are accrued are not allowed. Sir, whatever municipal taxes that are being paid is irrespective of the year, sir, that will be allowed in current year. Interest on loan borrowed for repairs of the property. Sir, you remember in house property we are allowed interest on loan? Yes, sir, we are allowed. If it is self-occupied house property, interest of rupees 2 lakh is allowed. If it is let out property, then interest of any amount is allowed. Right answer is yes, we remember. So in this case, so interest we have to reduce complete 1.5 lakh, 1,50,000. Sir, we have to reduce 30% standard deduction of 1,15,000. After reducing this, we will get the income from house property on gross basis. Our income from house property turns out to be lost from house property, that to 69,500. So we got this point. Also, sir, rent from arrears rupees 30,000 rupees received during the year which was not charged to tax in previous years. See, whenever you receive arrears of rent, it is taxable in the year in which it is received, and that too we get a standard deduction of 30%. So 30,000 into 70% will be taxable, that is 21,000 will be taxable. All in all, if I am asked, net taxability of house property will be, sir, 48,500 will be the loss from income from house property. A humble request from all of you. Is this point clear to you all? How did we arrive at this figure? Is it clear to you all? Is it clear to you all that how did we arrive at this figure? Okay, sir, we got this point. Mr. Singh's father acquired a residential house property for 1,25,000 and thereafter gifted the property to the SSC on 1st March 2007. Mr. Singh's father acquired in 2006 and in the same year he gifted to his son. Okay, sir, no issue. The property was gifted. The property so gifted was sold by Mr. Singh at a consideration of rupees 25 lakh. She. Very bad person. Whatever the property he inherited from his father, he sold it. She. Bad person he is. Sir, but whatever the price he is selling is important to us. That will be our full value of consideration, 25 lakh. Stamp duty charges paid by the purchaser at the time of registration is 13%. See, stamp duty charges are being paid, sir, 3,90,000. And sir, the percentage of such stamp duty charges is 13%. This implies stamp duty value of such property is 30 lakh. Oh my God. Oh my God. Can you see? Consideration is 25 lakh. Stamp duty value is 30 lakh rupees. Sir, what to do in this case? What to do? What to do? What to do? Sir, we have to disregard the consideration and take stamp duty value as consideration. Our full value of consideration will turn out to be 30 lakh rupees. Oh my God. Oh my God. Sir, cost of acquisition 1,25,000. Will such cost of acquisition be indexed? Will such cost of acquisition be indexed? Please reply. Will such cost of acquisition be indexed? Right answer is, since property is being transferred prior to 23rd July, then cost of acquisition will be indexed. Therefore, This 1,25,000 cost of acquisition will be divided by CII of previous year 6/7, that is 122, multiplied by CII of year of transfer 663. Therefore, index cost of acquisition will turn out to be 371,926. All in all, our capital gain will turn out to be 26,28,073. This will be the capital gain that will turn out to be. But sir, out of the consideration received, Mr. Singh on 1st Jan 2025 had purchased two adjacent flats in the same building, made suitable modifications to make it one. Investment was made by the separate sale deed amounting to 8 lakh and 7 lakh. Yesterday only we read this point that if we buy two adjacent flats from different person from different point of time at a different price, but we just made certain arrangements to make it as one flat, it will be considered as one only. It will be considered as one only. So exemption under section 54 will be allowed to rupees 15 lakh. Okay, sir, we got this point. Also, sir, on 10 July, 10 or 10 August or 10 October, 10 lakh were invested in the bonds of NHAI and allotment was received. So date of allotment is irrelevant. Date of allotment is always irrelevant, sir. We have to check the date of investment. So the date of investment is 10, date of investment is within 6 months. So we will be allowed exemption under section 54F of rupees 10 lakh. Sir, what will be the taxable amount? Taxable amount of capital gain will be 128,073. 128,073 will be taxable amount of capital gain. Also, sir, this is not the actual capital gain. This is not the actual capital gain. Sir, we will be allowed set off of house property losses. If you miss out at this point, examiner has right to deduct 2 marks. Examiner has clear cut right to deduct 2 marks. He is going to deduct. He doesn't just have right. He will exercise his right and he will deduct your marks. Your answer will turn out to be 79,570 will be 73 will be actual capital gain. Actual capital gain. To be very precise, 79,570 should be your answer. Oh my God, sir. Oh my God. How come? Absolutely correct. Sir, it was a simple question. It was a simple question. Is it clear to all of you? Is it clear to all of you? Just let me know in the comment section. Is it clear to all of you? See, I am a T kind of person. So you might see. Yes, sir, it is clear. Yes, sir, it is clear. You might see me sipping tea multiple times in this session. Yes, sir, clear. Okay, sir, absolutely clear. Come to question number 7. Sir, first half an hour or say 45 minutes we'll give to question answers only because this chapter contains a lot of questions which are important. So determine the capital gain loss. It can be either gain, it can be loss on transfer of listed equity shares and units of equity oriented mutual funds. STD paid, okay. If able, okay. Assuming that these are the only transactions covered under section 112A, so transactions are only covered under section 112A in respect of these assesses. Okay. Just listen to this question. It is a beautiful question. So Mr. Prashuns purchased 300 shares, okay, of A Limited for 400. Sir, 300 shares at the rate 400 is the cost. He sold all the shares on 1200. So sales price 1200. Full value of consideration will become 1200. Okay, sir. Sir, National Stock Exchange, the listing price, sir, whenever we are checking fair market value of any share as on 31st Jan 2018, whenever we are looking at the fair market value, we don't have to check the average. It is always the highest. So average 31st Jan 2018 FMV will be 700. Actual cost is 400. Sales price is 1200. Sir, sales price, if it is exceeding FMV, we have to take the lower one. 700 compared to 400, whichever is higher, we will take 700. So our capital gain turns out to be 500. 500 on 300 shares will give us 1,50,000 rupees worth capital gain. If we consider this 1,50,000 rupees, 1,25,000 is the exemption allowed to us. Date of sale, what is the date of sale? The date of sale is 31st May. So whatever the amount of differential capital gain turns out to be 25,000, that will be taxable at the rate 10% plus 4% education cess. See, I humbly request you all, as soon as the question is complete and you are clear with the question, just write down clear, sir, so that I am confident that you are able to understand it well. Question part two, focus. This is brilliant topic. This is brilliant topic. I just want you all to focus. Mr. Raj purchased 200 equity shares of 200 each equity oriented mutual fund, Fund A, Fund B on 1st Feb 2017 at a cost of 550. Fund A he bought, Fund B he bought, cost is 550. These were not listed at the time of purchase. Subsequently, A were listed on 1st Jan and Fund B was listed on 1st Feb. Okay, no issue. On National Stock Exchange, Raj sold all the units for 900. So, sales price is 900, 900. Details relating to quoted on National Stock Exchange, sir. Whenever we sell any kind of listed equity shares, sir, we have a benefit of FMV as on 31st Jan. Right answer is yes, sir, we have benefit. For considering benefit, we have to check whether such units of mutual fund, whether such units of business trust, or whether such shares are listed on 31st Jan or not. Sir, Unit A, Fund A is listed on 31st Jan. If you can see, Fund A is listed on 1st Jan 2018. Therefore, we can assume that it is listed on 31st Jan also. Therefore, if any fund is listed, then we have to take the highest trading price as FMV. FMV will turn out to be 750. Yes, sir, FMV will turn out to be 750 for this fund. Sir, but fund number 2, fund number B is not listed on 31st Jan. Just have a look at this date. Sir, it got listed on 1st Feb 2018. Then can I simply say that fund was not listed on 31st Jan? It got listed on 1st Feb only, so it was not listed on 31st Jan. No. Therefore, sir, if a mutual fund is not listed on 31st Jan 2018, then we have to take the NAV of it. So for that matter, FMV will turn out to be 950. Now here comes the beauty. Here comes the beauty. How capital gain will be calculated? Sir, full value of consideration will be taken as sales price 900, 900 for A as well as for B. Cost of acquisition, how it will be considered? Sir, actual cost. FMU or sales, whichever is lower compared to actual cost, sir, 750. Whichever is higher. Sir, in case 1, in fund A, sir, cost of acquisition will turn out to be 750. Sir, but in fund B, sales or cost, whichever is lower, sir, 900. Whichever is higher, sir, 900. 900. Sir, here capital gain will turn out to be 150. Here capital gain will turn out to be 0. Multiplied by 200, it will give us 30,000 rupees worth capital gain. What can be reasonably concluded from this point? Sir, we can conclude that, sir, government doesn't want to give FMV benefit in case of loss. If we would have taken FMV as cost of acquisition, without considering the sales price, if we would have taken FMV, then we would have arrived at loss, and government doesn't want to give any loss. That is the conclusion from this point. I hope you got the point. You will get the same answer. Sir, a beautiful question. So this question has to be held for NR taxation only if we are done with non-resident taxation, then we'll be able to do it. Otherwise, we will not be able to do this. Only one question we can solve right now is question number 8, and it is a beautiful, beautiful question. Are you all ready with me? Are you all ready with me to solve this question? Just say yes, sir. Absolutely ready. Because I want to see the excitement now. The excitement is necessary. I know it's morning time. I know it's festive season, but despite of all these things, we have to study. So just be prepared with the morning energy because that is what motivates me regularly. Yes, sir. Question number 8. Sir, beautiful question for capital gain that one can ever see. Should we do it at rough? I'm just cutting it down. I'm just cutting it down. I'm taking it. I'm taking my solution notebook and I'll solve it there. Sir, Sanjay is a resident of India. Oh my God. ठीक है. Age 55. He had an impressive portfolio in various mutual funds. He redeemed his entire mutual fund portfolio and bought a house villa in Lonavala worth rupees 2 crore. He sold all the mutual funds and went to Lonavala. Wow, what a life it is. We also want that life. The details of mutual fund are as follows. Sir, can you listen this thing? Is this thing echoing in your mind that if you are selling mutual fund and buying bungalow or residential house property, sir, an exemption will come into picture, that is section 54F. An exemption will come into picture because you are selling mutual fund and buying shares, sir. An exemption under section 54F will come into picture. BLR growth fund, sir. First of all, details are given. Let's read that details. Funds stated 1 and 2 have invested 30% of their proceeds in equity shares of domestic company. Funds stated in 3 and 4 have invested 70% of their proceeds in shares of domestic company. Oh my God, sir. Out of these funds, 1 and 2 invest 30% in equity shares of domestic company, DOMCO, and fund 3 and 4 invest, sir, 70%. What this indicates, sir? This indicates that fund 3 and 4 are equity oriented mutual fund. Equity oriented mutual fund. And fund and 1 and 2, fund 1 or 2 may be debt oriented or maybe, sir, 50 double A. They can be, sir, specified mutual fund also. If you remember, 50 double A states that if any of the fund has less than 35% is invested in listed equity shares of domestic company, then it is a specified fund, sir. But that fund has to be started on or after 1st April 2023. Then only it is specified fund. Sir, ABC fund has been started on or after 31st, on or after 1st April. Therefore, can I simply say, drawing the synopsis of this, so this is equity oriented mutual fund. This is also equity oriented mutual fund. This is fund, which this is specified mutual fund under section 50 double A. And this is, sir, debt oriented mutual fund. A regular debt oriented mutual fund, not specified one. Sir, do you all agree with me that how whatever classification I have made is correct? Right answer is, sir, we all agree with you. Now, sir, everything has to be checked. Sir, debt oriented mutual fund. First of all, talking about BLR fund. Sir, it was acquired on 3rd April 2021 and it was sold on, sir, 5th June 2024. Just out asking out of curiosity, is this mutual fund sold before 23rd July? Right answer is yes, it is sold before 23rd July. So we have to check period of holding concepts prior to that. Yes, sir, we have to check period of holding prior to 23rd July. So prior 23rd July, for any debt-oriented mutual fund, we had to check for 3 years. If such fund was held to, if such fund was held for 3 years, then it was long term. Otherwise, this would have been short term. Sir, is this held for more than three years? Right answer is yes, sir. It is held for more than 3 years. And sir, it will be long term. Yes, sir, it will be long term. Sir, if any asset is transferred prior to 23rd July, then in case of cost of acquisition, we shall take index cost of acquisition. Yes, sir, we shall take index cost of acquisition. So, bhaiya, in this case, we have to take the index cost of acquisition also. Sir, what will be the capital gain turning out to be? 140 minus 120 divided by CII of year of acquisition. What is the CII of year of acquisition? 21, 22. 317 multiplied by 363. This will be the amount of capital gain, and this will be taxable under section 112. This will be long-term capital gain under section 112. Are we clear with that? LTCG under section 112. Beautiful answer, Arjun. Beautiful answer. Beautiful answer. This is the thing I appreciate a lot. So second one. Sir, second one is second one is 50 AA securities. It is a specified mutual fund. This ABC strategic fund is a specified mutual fund. It is irrelevant whatever the period of holding we have. It is irrelevant the period of holding we have. It will always be short term. It will always be short term. So capital gain will turn out to be 4 lakh rupees. That too short term capital gain, and that too regular one, not the triple one A. Yes, sir, that's correct of you. Third one, ABD mid cap fund. ABD mid cap fund. Just have a look at this. Sir, is it equity oriented? Right answer is yes, equity oriented. For equity-oriented mutual funds, we have to check period of holding for 1 year. If it is held for more than 1 year, then it is long term. Otherwise, it will be short term. Is it held for more than 1 year? Right answer is no, it is not held for more than 1 year. It is held for less than 1 year. In this case, what will happen? What will turn out to be? This will turn out to be short term and triple one A wala short term. In this case, sir, capital gain will turn out to be 118 minus 115 is will be 3 lakh. It will be short-term capital gain under section 111A. Oh my God, everything is just coming at us like a bazooka. Everything is coming at us like a bazooka. Beautiful, beautiful, beautiful. And at last, sir, it is also equity-oriented mutual fund. SBA fund is also equity-oriented mutual fund. Is it held for more than 1 year? I can apparently see it was acquired in 2022. It was sold on 2024. Therefore, it is long-term capital gain. 10 lakh amount will be long-term capital gain, and it will be LTCG. Since it is equity-oriented mutual fund, it will be under section 112A. Did you see all kind of capital gain in one question only? This is the only question. All kind of capital gains that we can ever have is in this portion. So just out of curiosity, can you all answer the tax rates at which they will be taxable? See, first one is 112. First one is capital gain under section 112. It was sold prior to budget, so tax rate will apply at the rate 20%. Second one is 50%. Second one is 50 AA. It is always short term. It is otherwise short term, so it will be taxable at the rate slab. Third one is STCG triple one A. Is it sold before budget or is it sold after budget? Sir, it is sold before budget, so it will be taxable at the rate 15%. And fourth one is 112A. Is it sold after budget? Right answer is yes, it is sold after budget. In this case, it will be taxable. It will be taxable at the rate 12.5% over 1.25 lakh. Beautiful, Arjun. Beautiful. Can you all tell me the total capital gain amount? Total capital gain amount will turn out to be 19.5867. Oh, this is the capital gain amount. Are we clear till this point? Are we clear till this point? Right answer is yes, sir. Absolutely clear. What's the issue in this? What's the issue in this? It's a simpler point. It's a plain vanilla point. We got this point. Sir, but our answer is still not over. Our answer is still not over. Sir, why our answer is still not over? Because portion is left, sir. We have to compute 54F exemption also, na? We have to compute exemption under section 54F, na? Right answer is yes. Sir, section 54 exemption will not be allowed on this point. It will not be allowed. It will not be allowed on short-term capital gain. It will not be allowed, sir. It is apparent from records. It is apparent that we will not be getting exemption on short-term capital gain. It has to be on long-term capital asset only. So exemption will only be allowed on this security and on this security. Whatever the highlighted are in the blue ones, on that we will get the exemption. Right answer is yes, sir. That means exemption can be claimed on 2.5867 lakh and exemption can be claimed on 10 lakh. Sir, sir, this 10 lakh capital gain arose out of the net consideration of 120. So we have to utilize amount from 120 lakhs. This 2.5858 lakh came out of mutual fund from which consideration received is 1.4 lakh, 1.140 lakh. Yes, sir. Now the best part comes out to be, sir, we have to use this net consideration for acquiring the new asset. We have to use the net consideration for acquiring new asset, and total net consideration uses 200 lakh. Now how do we allocate what amount of mutual fund has been used to buy the house? From which mutual fund exactly have we used money to buy this house? Sir, we do not have any such split. So for that matter, we will use the split which is most beneficial to all. We will assume that out of this 120 we have used complete 120, and remaining 60 lakh have been taken from this mutual fund to make this capital gain completely exempt. To make this capital gain completely exempt, we will assume that all of the money from this mutual fund has been taken and invested in the house of the Lonavala. Therefore this will become exempt, and this 10 lakh will become exempt, and this 2.5867 will become exempt proportionately. 1.10859, this will be the exemption amount. Now this has to be reduced from 19 lakh. Capital gain taxable term will turn out to be 8.4781. This is how things will turn out to be. Let me check the answer. 8.4781. Did I do any mistake or what? Oh Baba Ray, this 80 now, this 80 now. What mistakes I am doing? No issue. No issue. 2.5868. 1.4781. Okay, sir, no issue. We got the answer. We understood the provision now. See, this is the advantage of live classes also. See, this is the advantage. I am also bound to make mistakes. I don't know how many times I have solved this question, but even though I do some mistakes while solving. So you are bound to make mistakes in most cases. It is not necessary that despite of 100% practice, you will be able to solve it 100% correct. Sir, it is a journey. You need to understand that understanding concepts and solving question answers properly is a journey. At first, you might face multiple issues. You might do 10 mistakes at once. But over the period, this 10 mistakes will turn out to be 5. This 5 mistakes will reduce to 2. This 2 mistakes will reduce to 1. And this 1 mistake will occur only after multiple attempts. This is the journey. But still, mistake is bound to happen when when you are solving. Despite of doing it multiple times the same question, you are bound to do mistakes. So you need not to worry about it at all. You can take it as confidence. You can take it as this confidence that even I can do such clerical issues. Then you can also do that, and it is allowed humanly, it is allowed. So this is the right answer. Oh, done with the question. Sir, if they would have asked us, then we would have taxed it also. But they might do it wrong. They might themselves do it wrong. They might themselves do it wrong. But if they would have asked us to tax it, we would have taxed it also. Taxation is not that difficult. Applying tax rate is not difficult. We have already considered tax rates. We just have to apply them. Okay, I guess all the questions that we can do are done. All the questions that possibly we can do from the Kaplan are done. Okay, we have a question from slum sale. We can still do that. We have a question from slum sale. We can do that. Sir, will you all solve this on DPQ basis? You know, yesterday 3 students have sent me their DPQs. Yesterday 3 students sent me DPQs. And this Sanjay question that we are discussing today, that we discussed right now, was given in practice yesterday. So today I'm giving you one practice question, question number 14 of Salsi Limited. And tomorrow we'll solve it. GPQ 2, question number 14, Salsi Limited of Super 100, capital gain, slum sale topic. It is beautiful question. It's a beautiful question. You must solve it. 3 students sent me this DPQ. I request all of you who are watching this lecture, whether live, whether recorded, I will be the one checking how to share to you. Arey Baba, how to share to me? Are you gonna Arjun? Are you connected on my Telegram channel? Whenever I message on Telegram, you can directly share. You can directly share messages to me. If not, I have given my number to you. You have to send your answer to me on this Telegram number. You are not going to send on WhatsApp. You are not going to send on any other social media platform. You just have to send it on Telegram. Sir, proceeding further. Proceeding further, we have to start with a very important concept called transfer of capital asset from partnership firm to partner and partner to partnership firm. This is a beautiful concept, sir. For that, I want to take you to notes. I'll take half an hour of complete attention. Half an hour of complete attention. Nothing else. I just started off with question answers for the simple reason that I just want your attention for at least some time. Okay. Transfer of capital asset from from partner to firm firm to partner. If partner transfers any asset to partnership firm, then it is taxable in the hands of partner. Taxable in the hands of partner. And what will be the amount of capital gain? The amount of capital gain will be, sir, for that matter, you have to calculate full value of consideration minus cost of acquisition. So cost of acquisition, you already know whatever the price at which partner has acquired. Full value of consideration will turn out to be amount recorded in books of accounts. Amount recorded in books of accounts by the firm will be full value of consideration. This will give us capital gain. So this has been iterated in section 45.3. This has been given in section. This has been given in 45.3. Sir, we are done with this portion. Done, sir, done. Oh wow, sir, wow. What if assets are being transferred via firm to partner? If firm transfers any asset to partner, ordinarily, no taxation as such. Because ultimately, sir, partner is due certain amount, therefore no taxation will arise. But sir, if firm transfers any capital asset or any stock in trade at the time of dissolution, section 9B will apply. If firm transfers capital asset or stock in trade at the time of reconstitution, 9B along with that 45.4 shall apply. 9B along with 45.4 both will apply. Oh my god. Oh my god. Oh my god. Sir, what is reconstitution? Reconstitution imply change in PSR, profit sharing ratio is being changed, admission of partner, retirement of a partner, or death of partner. So this all imply reconstitution. Dissolution of firm when firm closes. This is the basic definition, sir. Now all I need to tell you is section 9B and 45.4 and we'll be done with this topic. All I need to tell you is section 9B and 45.4 and we'll be done with this topic. Sir, clear? See, please be hyperactive at this point of time because whatever you are understanding, I must be clear with that. Sir, let us take an example. We have a partnership firm called ABR firm. We have a partnership called ABR, where A was a partner, B was a partner, and R Rahul was partner. All had share capital of 2 crore, 2 crore, 2 crore. All had share capital of 2 crore. They had assets like building, acquired, yeah, I must say land, acquired on 1st April 2018, worth rupees 2 crore. They had shares at rupees 3 crore and other assets worth rupees 1 crore. Balance sheet tallied to 6 crore. On 1st April, Rahul retired. On retirement, if you are aware from your junior classes, at the time of retirement, at the time of dissolution, normally firm revalues its asset, and sometimes instead of paying money to the partner, firm directly gives certain assets to the partner. So on retirement, firm revalued its assets and gave land to Mr. Rahul. Sir, Rahul has outstanding capital of 2 crore rupees and he has been given a land of rupees 2 crore rupees. Sir, it appears to be a clear equation. But sir, valuation turned out to be something different. Sir, fair market value of this land was 4 crore. Sir, the shares were valued at 4 crore. These other assets were valued at sir, 2 crore. Oh my God, sir, this was the FMV as they were realized at as they were recorded at the fair market value. Sir, are you all clear with the story? What has happened? I have not taught any taxation implication. I have just taught you the story. What has happened in this case? There were three partners, out of which Rahul retired. Rahul had outstanding capital of rupees 2 crore rupees. As he retired, he was given a land whose book value was 2 crore rupees. I have to tax this transaction. I have to tax this transaction. Are you? Is this story clear to you all? Are numbers in in this example clear to you all? Right answer is yes, sir. It is clear. Yes, sir. They are clear. Sir, first of all, what Nimotai says, what Nimotai asks us to do, what we are required to do. First thing, sir, assume that asset has not been given to partner. Assume, assume that asset has not been given to the partner. Then what taxation implication would have been? Government wants us to know. So just imagine if this land would have not been given to the partner and this land would have been sold to an outsider, then there would have been certain tax implication. What tax implication would have been? What tax implication would have been? Sir, if this land would have been sold to an outsider, then full value of consideration would have arrived at 4 crore. Cost of acquisition would have been 2 crore. But since property is transferred prior to 23rd July, then we would have got index cost of acquisition. What is index cost of acquisition? Just let me take the indexation list. Previous year 1718, yes, 1718, no, sorry, 1718 now. It asset was acquired on 1st April 2018. 18 so CII of 1819 will apply. 280 into 363, yes sir. 2.5926. Capital gain in the hands of firm will turn out to be 1.40714. Tax in the hands of firm will be applicable at the rate 20% plus 12% plus 4%. Just give me a second. Huh? The tax turns out to be 32,78,080. This is the amount of tax that turns out to be. Sir, first of all, I must ask you all, is it fair enough to ask this tax? Is it fair enough to ask this tax? Right answer is yes now. Right answer is yes. Simply why? Because sir, if this asset would have been sold to an outsider, then this is the simple tax liability that would have arisen. That would have arisen. If this asset would have been sold to an outsider, then this tax would have been required to be paid now. This tax was required to be paid. So there is no doubt whatsoever that this tax liability would have arisen if this asset were sold to an outsider. So this tax is required to be paid. So this tax is payable under section 9B. Oh my God, sir. Oh my God. 9B done. Yes, sir, done. Yes, sir, done. Yes, sir, done. Sir, 9B ask you 9B requires you to assume that this asset is being sold to an outsider. Instead of giving it to a partner, assume it has been sold to an outsider. Then whatever the capital gain arises, pay taxes on that. That is what section 9B says. Are we done with section 9B? Are we done with section 9B? Are we done with section 9B? Arey Baba, are we done with section 9B? Right answer is yes, sir. We are done with section 9B. Sir, if this asset would have been sold to an outsider, then this was the amount of capital gain. This was the requisite amount of capital gain tax under section 112 required to be paid by the firm, by the partners. Sir, government wants us to think beyond that. Government wants us to think beyond that. Sir, what government wants to think? Is it for stock in trade also? Yes. If this would have been stock in trade given to partner, then we have to take full value of concession minus cost of acquisition. This will become PGBP. This will be taxable under that PGBP. If this would have been a stock in trade, then this would have been taxable under that PGBP. Sir, continuing further, government wants us to think beyond this thing. Government wants us to calculate the capital account if this would have been sold to an outsider. Just imagine, these were the share capital of A, B, and R. They had a share capital of rupees 2 crore rupees each. 2 crore each they had they had partners capital. If this land would have been sold to an outsider, then as per books of accounts, they would have had gain of 2 crore rupees, which were to be divided equally. Yes. If this land would have been sold to an outsider, then each of the partner would have had a book profit of rupees 67 lakh. 67 lakh. Yes. For sake of simplification, 67 lakh would have been the capital, would have been the book profit. Their capital would have increased. See, as per income tax at capital gain may be different, but as per books of accounts, their capital would have been increased by 67 lakh only now. As per income tax, taxable capital gain may be different because of indexation, because of fair market value. There might be difference. But actual books of accounts profit will turn out to be 2 crore, and this 2 crore will be added in the capital. Yes or no? Yes, sir. It will be. It is the case. If this asset would have been sold to outsider, then books of accounts would have been increased by this 67 lakh rupees profit. Also, if this asset would have been sold to an outsider, then they were required to pay taxes of rupees 30 lakh, 30 lakhs, 32 lakh 70,000, fairly assuming 11 lakh taxes are being apportioned to everybody. Sir, reasonably assuming that 11 lakh taxation, 11 lakh assets have been 11 lakh tax, sorry, 33 lakh taxes have been divided into three partners, 11 lakh everybody is required to pay. For simplification, I'm assuming 11 lakh has to be paid by everybody. Can I say, if this asset would have been sold to an outsider, then every partner's capital would have turned out to be 2.56 lakh, 2.56 crore. What I'm saying is, sir, what I'm saying, just listen to this point. Government requires us to think this way. If this asset would have been sold to an outsider, then this was the profit amount that you would have added to your capital. Yes, sir, this is the profit amount that we would have added to our capital. If this asset would have been sold to an outsider, this would have been the tax amount that you were required to pay. Yes, sir, this was the tax amount. If this asset were sold to an outsider, then this would have been your capital account. This would have been capital account. Yes, sir, this would have been a capital account. Sir, if this asset would have been sold to an outsider, then Rahul was required to be paid, sir, 2.56 crore only. Rahul was required to be paid 2.56 crore. If this asset would have been sold to an outsider, Rahul was required to be paid rupees 2.56 crore. Why did you pay him 4 crore assets? Why did you give him asset worth rupees 4 crore? Why did you give him? Why did you give him? Government wants to know why did you give Rahul asset worth rupees 4 crore? Provision in turn responds, sir, there might be hidden benefit that you would have got from Rahul. There might be some hidden benefit that you would have got from Rahul. Therefore, whatever extra that you are paying is something hidden benefit that you have that Rahul has given you. Therefore, 144 lakh is taxable because you have got some benefit from Rahul. You have got some benefit from Rahul. That is the reason why you are paying him access. That is the reason why you are paying him access. His capital was due worth rupees 2.56 crore. Why are you paying assets worth rupees 4 crore? You might have got certain benefit from Rahul. Therefore, you have to pay taxes on this 1.144 lakh, or I should say 1.44 crore. This is taxable under section 45 4. But sir, there is something wrong. Arey Baba Ruko. Wait. But sir, how is it possible taxing say Arey wait. Sir, but same asset has been given to partner and taxing two times. Arey Baba, I understand this thing. But this is how things go. This is how things go. This is how things go. That if you give partner any asset, first of all, you have to tax it the way it would have been sold to an outsider. Second thing, you have to check whatever his capital account would have been and check whatever the amount in access to his capital you have given to him. That will be taxable again. Isn't it double taxation? Isn't it double taxation? Isn't this double taxation? Right answer is yes, sir. This is double taxation. This is double taxation, sir. This is double taxation. Double taxation. This is double taxation. How to avoid this double taxation? So there is a provision given by fine. There is a provision given in the act to avoid this double taxation. So what provision says? At the time of reconstitution, other than asset given to the partner, sir, what all other assets are being revalued? Just find out. If we look at the balance sheet, we'll find out that shares which were worth rupees 3 crore have been revalued to 4 crore. That means there have been revaluation gain of 1 lakh. Other assets which were at 1 crore have been now revalued at rupees 2 crore. That means the revaluation gain is 1 lakh. Provision says, whatever the capital gain that you have accrued, under section 45(4) has to be split in the ratio of the revaluation done. Like in our case, revaluation done was 1:1. Whatever the increment of 1 crore rupees were on shares, and same increment was for other assets. So this has to be split in the ratio of 1:1. That means 72 lakh rupees worth of capital gain will be apportioned to shares, and 72 lakh rupees worth shall be apportioned to other assets. Sir, what will happen? 72 lakh worth rupees were capital gain. 72 lakh worth rupees of capital gain will be apportioned to shares, and 72 lakh rupees worth of capital gain will be apportioned to other assets. What we'll do of this capital gain? Provision says this will be used to set off when you are having future capital gain. For example, if you are selling these shares worth rupees 5 crore, cost of acquisition were 3 crore, so 2 crore would have been capital gain in future, then you will be getting a set off of this old apportioned capital gains that will be required to be paid later on. In future, if you sell such shares at a higher price, then whatever the apportioned capital gain to these shares were will be reduced from final tax calculation, will be reduced from final capital gain calculation. This was all about section 9B and 45(4). I'm just briefing you out whatever we have studied. See, we are doing this revision, so I think this is the proper depth that was required for you to understand. I'm briefing you out again whatever we had studied. Whenever a partnership firm gives any asset to partner, it is normally not taxable. But if such firms give any asset at the time of dissolution, or if such asset is being given at the time of reconstitution, then we have to follow two sections, section 9B which is applicable in both the cases, dissolution and reconstitution. Section 45(4), which is only applicable in case of reconstitution. Section 9B requires us to compute capital gain as if this were never given to a partner. This asset was given to an outsider. We have to calculate capital gain in such manner. We have to calculate capital gain in such manner as if this asset were sold to an outsider. Okay, sir. Section 45(4) requires us to think beyond that. It requires us, just imagine that this asset would have been sold to an outsider, then what would have been the capital amount? What profits that would have been added to capital amount? What taxes would be reduced, and what capital gain would have been arrived if this asset were sold to an outsider? Then you have to compare such arrived capital with the assets that are being given to the partner. Whatever the difference turns out to be, this has to be interpreted in a manner that is the benefit given to the partner. That is the benefit given by the partner to the firm. So that should be taxable under section 45(4). But since it is the only asset being transferred to the partner multiple number of times, multiple taxation occurs. Therefore, section 45(4), whatever capital gain we are arriving at section 45(4) will be apportioned in different assets. Whatever capital gain we are arriving, that shall be apportioned on different assets. And what will be the ratio of apportionment? So ratio of apportionment will be the revaluation gain on the other assets. Revaluation gain on the other assets. In our case, revaluation gain was 1:1. Therefore, capital gain was apportioned 1:1. And what will happen to this capital gain? Provision says whenever you are going to sell such assets in later part of this business, if you are able to sell such shares, then whatever this apportioned capital gain is will be reduced from then calculated capital gain. That is how things go in this provisions. Let's take another example which has been given in the book. Without reading any provision, I just want all of you to read this example. Full on attention. I said now full on attention. Mr. Prem is a partner. If you have missed out anything, you still have an opportunity to grab it. If you have missed out anything, you still have an opportunity to grab it. Mr. Prem is a partner in X and Company. Okay. Mumbai, and has 4 partners. X and Company has 4 partners, and one of them is Mr. Prem, including Prem, who share profit and losses equally. So their PSR, their profit sharing ratio, is nothing but, sir, 1:1:1. That means Prem has sharing ratio of 25%. Prem resigned. On from X and Company on 1st April 2024. On the said date, partners' capital of each of the partners stood at 32 lakh. Each of the partners' capital was 32 lakh. In order to settle the dues of Mr. Frame, the firm revalued its land for the first time since purchases. The valuer also valued self-generated goodwill at 70 lakh rupees. The firm has including following assets whose details are given as follows. Sir, there was a land in Pune which was acquired on 21st Jan 2013, which was acquired for rupees 15 lakh, is now being revalued at rupees 50 lakh. There is revaluation gain of 35 lakh. Yes, sir. There was land in Nagpur which was acquired on 18th April 2015. It was acquired for 25.4 lakh and it has now been revalued to rupees 45 lakh. Sir, what is the revaluation gain? I can guess 19.4 is the revaluation gain. 19.4? 19.6 is the revaluation gain. Land at Mumbai, sir, it was worth rupees 88 lakh and it has now been revalued to 250. The revaluation gain is 162. Self-generated goodwill was 0 and it has now been revalued at 80 lakh rupees. So 80 lakh is the revaluation gain in case of goodwill. Okay, sir, we got this point. In 1st April, X and Company gave land at Nagpur. Sir, this Nagpur land has been given to him. Nagpur land. See, this is where This is where something went wrong is to be identified. His capital was outstanding 32 lakh rupees and you are giving him worth rupees 45 lakh. Land worth rupees 45 lakh. Along with that, you are not stopping there. You are giving 15 lakh rupees money to settle his cash dues. That means you are paying him much, much, much more than what he is required to be paid. Oh my God. Oh my God. Discuss the tax treatment in the hands of extended companies. Sir, what tax treatment will apply? See, since it is reconciliation, first of all, government wants us to think that don't think that this asset has been given to a partner. Assume that this asset is sold to an outsider. This is the first step that government wants us to think. See, if this land at Nagpur would have been sold to somebody outside, then simply full value of consideration would have been 45 lakh. Simply full value of consideration would have been 45 lakh. Right answer is yes. This would have been full value of consideration. Yes. Cost of acquisition 25.4. Sir, we have studied this point. If asset is sold prior to 23rd July, then cost of acquisition shall be taken as index cost of acquisition. Sir, divided by CII of year of acquisition multiplied by CII of year of transfer. Sir, 36.3. Capital gain turns out to be 45 lakh minus 36.3. 8.7 lakh capital gain will arise in the hands of the firm. 8.7 lakh capital gain will arise in the hands of the firm and it will be taxable at the rate 20% plus 4%. Now, this is the amount of capital gain that firm requires to pay under Section 9(b). This is the amount of capital gain that firm is required to pay under Section 9(b). Oh my God. Oh my God. Hmm. Hmm. Sir, I'm asking again, is it clear till now? Do you have any issue till now? So this is 9B is the most logical thing because this is the normal parlance. Now, if you are giving it to partner, assume if this would have been sold to an outsider, then the firm would have been liable for taxes now. So firm is required to pay taxes under 9B if this asset is given to an outsider. This is the most reasonable thing to ask. This is government is asking this reasonably, and it is reasonable to ask. This is what this point also says. Net tax payable under section 9B will be 189.60. Yes, sir, it is correct. We accept this fact that is correct. Now, government wants us to think beyond that. First of all, every partner's capital is 32 lakh. If this asset would have been sold to an outsider, if this asset would have been sold to an outsider, what would have been the book gain? Sir, cost of acquisition of the property was 25.4 land. If this land would have been sold to an outsider, then accounting gain would have been 19.6. This accounting gain was to be shared between all partners. 4.9 lakh rupees accounting gain would have been accrued to all partners. But sir, 180,960 is the taxes amount. So taxes amount calculated above is the taxes amount that has to be shared between all partners. 45,240 is the taxes amount to be reduced. Actual capital gain after all the adjustments would have been this. Actual capital gain after all the adjustments would have been this. Sir, any issue till now? Any issue till now? Sir, if this asset would have been sold to an outsider, partner's capital would have been 36 lakh rupees. After all adjustments of capital gain, after all adjustment of taxes, partner's capital would have been this much. Yes, sir, we agree. Now, what amount has been given to the partners? Just imagine, partner is given 45 lakh rupees worth of land, 15 lakh worth rupees of cash. That means he has been given 60 lakh rupees and his capital is just 36.44760. That means he has been given way much more than what he was required to be paid. Therefore, 23 lakh 55,240 is the taxable capital gain under section 45(4). This is the taxable capital gain required to be paid under section 45(4). Did I make it very clear? Now, since what is happening? Firm is giving an asset to the partner. Government wants us to think pay taxes under Section 9B. Government again wants to tax us under Section 45(4) by saying that you are giving access to his capital, you are giving more than what his capital owes to you. We are taxing the same transaction twice now. So government wants us to distribute this capital gain to the various assets. Sir, what are the various assets? Sir, we have land at Pune, which is revalued at 35 lakh. We have land at Mumbai, which is revalued at 162, whose valuation has been increased by 128 lakh. And sir, we have self-generated goodwill. Provision says distribute this 23 lakh 55,240 capital gain in the ratio of 35 is to 162 is to 70. You have to split this in this ratio and apportion the capital gain to these various assets. Apportion the capital gain to these various assets. Oh. Whenever I will be selling this Pune land in future and whatever capital gain will arise, we will get a deduction of this earlier paid capital gain, earlier taxed capital gain. So just understand this with example. Sir, for example, what capital gain in ratio of 35 is to 267 is to be attributed to Pune land. Capital gain attribution turns out to be 308,740. Capital gain attribution turns out to be 308,740. In future, if in case we sell this Pune land, whatever the attribution turns out to be shall be reduced from capital gain, and our capital gain will be arrived after reducing such capital gain. That is how things go. There is also proviso to this section. There is a proviso that provisions of section 9B and provision of section 45(4) apply mutatis mutandis to a AOP. If any asset is being given by AOP to its member at the time of dissolution or at the time of reconciliation, same to same as it is provisions are going to apply in that transaction also. We're done with that topic. Come to section 46. Section 46 talks about transaction taxation in case of liquidation. Section 46 talks about liquidation. Section 46 talks about liquidation. Sir, what this liquidation talks about? See, if I have shares of a company, sir, and by default company liquidates. By default company liquidates. Company is into dissolution process and later on liquidation process. My share capital is wiped out for no reason. My rights in the company are being extinguished. Therefore, there will be capital gain in my hands. No taxation in the hands of the company, rather it will be taxation in my hands. Therefore, no taxability will arise in the hands of the company, rather taxability will arise in my hand. Sir, assume this fact. For example, we have a company whose share capital is 1 crore, reserves are 4 crore, and this company has only land of rupees 5 crore. Now, if this company liquidates, just assume this company liquidates, and shareholder is only Rahul. Shareholder is only Rahul. Only shareholder is Rahul. Just assume that this company liquidates. Rahul will be given this land. Rahul will be given this land. Yes, sir, Rahul will be given this land. Do you remember a provision from IFOS? Do you remember a provision from IFOS that if any asset is being distributed at the time of liquidation, then any such distribution shall become deemed dividend. Any such distribution shall become deemed dividend to the extent of accumulated profits. Do you remember this provision? Provision says if this land is being distributed, whose fair market value might be 10 crore, whose fair market value might be 10 crore. If this asset has been distributed, out of this 10 crore, 4 crore will become deemed dividend. 4 crore will become deemed dividend. Right answer is yes, sir. 4 crore will become deemed dividend. So provision says on remaining amount capital gain will apply. Remaining amount capital gain will apply. Sir, what it says, let us understand. Sir, in this transaction, full value of consideration shall be taken. Sir, 10 crore land is being given. Full value of consideration shall be FMV of asset received. FMV of asset received. FMV of assets. From full value of consideration, reduce the amount charged under section 226 to 222C. 4 crore have been charged under section 222C. Therefore, full value of consideration will turn out to be 6 crore. Out of this reduced cost of acquisition is nothing but the purchase price of the shares. Purchase price. Purchase price is 1 crore. Therefore, taxable capital gain will turn out to be 5 crore. Taxable capital gain will turn out to be 5 crore. Is it 5 crore? Yes, 5 crore. Just imagine a land which is 5 crore in books is actually worth rupees 10 crore. So we are just being charged on 5 crore only. 4 crore will go to sir IFOS and it will be taxable under the head dividend. It will be taxable as dividend. I hope you got the point. So there is a provision sometimes ICI asks. Acha, is it clear? Dividend is clear. This portion is clear how taxation and liquidation takes place. How taxation and liquidation takes place. Is it clear? Is it clear? Is it clear? Is it clear? Just let me know. Is it clear how liquidation taxation works out? Do you have something in your mouth like curd or something, or do you have certain mehendi, matlab, code on your hand because of which you are not typing? Sir, yes, sir, clear. Sir, my doubt to all of you is, my doubt to all of you is, sir, if I have capital gain of rupees 5 crore rupees in case of liquidation, say liquidation took place in the company, assets are being distributed by the company to the shareholder, capital gain arose in my hand. Can I claim exemption under section 54, 54B, 54D, 54 EC, 54F on this capital gain? Can I claim any of the exemption? Sir, 54 is not available because 54 is only available in case of house property. 54B is also not available because it is available only for urban agriculture land. 54D, compulsory acquisition of industrial land taking. Arey Baba, it is just liquidation. 54 EC, only available for land or building. Can I claim exemption under section 54F? Can I claim exemption under section 54F? I want all of you to answer. I want all of you to answer. Hello. Everything clear now? Everything clear now? Am I audible properly? Okay, perfect. So, what my query was, sir, audible, perfect, perfect, perfect. Albert on to okay. Albert, why don't you reply normally? This is for the first time I'm seeing your name. You do not reply normally. Why? Okay. So what this provision says, see, what I was talking about, if you have any kind of capital gain on account of liquidation, provision normally doesn't allow you to claim exemption against that exemption under section 54F. Why, sir? Why government does not allow? Because, sir, government normally says it is a kind of deemed capital gain. This is a kind of deemed capital gain. A word has been coined here, a deemed capital gain. It is not actual capital gain. This is deemed capital gain. Therefore, no exemption will be allowed. This word has never been used in Income Tax Act. This word has never been used in Income Tax Act. But ICI out of nowhere uses this words in case of liquidation. If you solve any question of liquidation, you will find out that government normally does not give any exemption. Government does not give any kind of exemption on section 54F. That is what it says. That is what how things are done. Sir, come back to question answers. Question number 5. What it says, Aries Tubes. Aries Tubes went into liquidation on 1st June 2024. The company possessed the various funds prior to distribution. Acha, oh, it has too much of funds. Share capital was issued on 1st April 2013. Reserves prior to distribution was 3 lakh. Excess realization in case of liquidation was 5 lakh. Okay, sir, got this point. There were 5 shareholders whom received the 260. 2 lakh 60,000 were received, 2 lakh 60,000 rupees each shareholder was receiving. Just imagine total assets were 13 lakh divided by 5 is nothing but 260 now. Okay, sir. Each shareholder received 260 from the liquidation. The shareholder desired to invest resultant elements in capital gain and long-term specified assets defined in section 54 EC. Sir, these shareholders, how capital gain tax paglu these shareholders are. How tax paglus these shareholders are. They want to invest any such sum into 54 EC bonds. Sir, 54 EC bond does not allow. For claiming exemption under section 54 EC, you have to buy any assets by selling by selling immovable property. You can only claim 54 EC by selling immovable property. You cannot claim 54 EC elsewise otherwise. So 54 EC is clearly disallowed. Sir, but how capital gain will work out? Sir, first of all, 2,60,000 rupees is the full value of consideration. Out of which, sir, reserves amounts to rupees 3 lakh divided by 5. Sir, 60,000 rupees will be taxable under deemed dividend portion. 60,000 will turn out to be deemed dividend under section 222C. Minus cost of acquisition, sir, each shareholder has invested 1 lakh rupees, so this will become cost of acquisition. So actually taxable capital gain will turn out to be 1 lakh. And sir, you cannot claim exemption under section 54 EC on this. You cannot claim under section 54F on this. Sir, for EC, why can't you claim? For EC, why can't you claim? Because it is not immovable property for which you are transferring. 54F you can't claim because provision calls it a deemed capital gain, because of which there is no actual capital gain. Therefore, you cannot claim exemption on that. Exemption under section 54 EC is available only when there is actual transfer of capital asset and not in case of deemed capital gain as per the decision rendered in CIT versus Ruby Trading Company. Therefore, exemption under section 54 EC will not be available since it is deemed a transfer. Furthermore, with effect from 50/18/19, as a exemption under section 54 EC is available only in case of long-term capital asset being building and land. Are we clear with that point? Because if we are clear with that point, then we are done with the chapter. Arey Baba, we are done with the chapter, sir. We are done with the chapter. Starting off with next chapter, that is income from other sources. Before starting this chapter, I want all of you to respond. I want all of you to respond, sir. Any doubt? First of all, if you have any doubt, just comment down. Second thing, sir, what was the charging section of capital gain? What was the charging section of capital gain? What was the charging section of capital gain? I'm asking charging section for capital gain. Arjun, charging section for capital gain. Sir, capital gain was chargeable to tax under section 45(1). 45(1) clearly states that any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer took place. Some keys no working in my laptop keyboard. No issue, Albert. Sir, if you are being asked charging section of capital gain, it was 45(1). If you are being asked charging section of house property, it was sir 22. It was C inter topic, not in CFN. If you are being asked charging section of salary, sir, it is section number 15. Oh. If you are being charging section of sir PGPP, it is section number 28. So every head of income has some or the other charging section. Similarly, income from other sources is also chargeable to tax as per section number 56(1). And what 56(1) says, if any income which is not chargeable under that salary, if it has been kicked out of the salary, if this income has been kicked out of house property, if this income has been kicked out of PGPP, if this income is not chargeable under the head capital gain, and also sir such income is not exempt, then in that case it shall be taxable under the head income from other sources. What I am saying is, sir, income which is not chargeable to tax under any head, then it shall be taxable under that IFRS. Sir, you must remember, first of all, we have to check the other heads, and then if such income is not taxable in those heads, then only we'll come to charging section. Sir, for example, I am getting married. Sarthak sir is my employer, and on my marriage, he gifts me a gold chain. On my marriage, he gifts me a gold chain. So that will not be taxable under IFRS. That will be taxable under salary because he has an employee-employer relationship, and because of which he's giving me a gold chain. He is giving me a gold chain because of employee-employer relationship. Therefore, any money received, any gift received on account of employee-employer relationship shall be taxable under that salary. So you must be very, very much clear that first of all, you have to check for income that is taxable in other sources, sorry, that is taxable in other head. If it is not taxable elsewhere, then only it will come to IFRS. We'll discuss about this in latter part of the session. So section 56(2) states down certain items that shall always be taxable under the IFRS or that shall be taxable IFRS in certain senses. First of all is dividends. A dividend is always IFRS. Dividend is always IFRS. Even for the one who has securities held as stock in trade, dividend will be IFRS. If your business is buying and selling of securities, then too it will be IFRS. If you are an investment fund, if you are an FII, then too it is always IFRS. Dividend by default is income from other sources. It can never be business income. Dividend can never ever be business income. Sir, but still we have too much of dividend to be discussed in latter portion. Sir, I am marking it as blue. Interest on securities banks, sir, we have to discuss in the latter part. I am highlighting in blue. Sir, interest on lottery, sorry, winnings in case of lottery, card games, puzzles. So this is to be discussed in other chapter. Income from online gaming to be discussed in other chapter. Income from letting out of land and machinery, if not chargeable to PGBP, then it shall be taxable in IFRS. Okay, no issue. This has to be studied in this portion only. Income from key managerial insurance policy. Any amount received on account of KMP. See, if a company does any kind of key managerial personal insurance, for example, if company's name is Reliance, and company wants to get insurance of Mukesh Ambani because Mukesh Ambani is the key managerial persona of Reliance now. If whatever happens to Mukesh Ambani, then may Reliance may drown, Reliance may get closed, Reliance may get even liquidated, Reliance may suffer losses. So for that matter, health of Mukesh Ambani is of the utmost priority for Reliance. So most of the times what companies do, they buy key man insurance policy for such employees. In that case, any receipt, any sum received on account of such KMP is always taxable under that PGBP. Any money received on account of such key managerial personnel is always taxable under that PGBP. But there are certain situations where such policy is not taxable under PGBP, but taxable under income from other sources. That question will itself give to you. Question will in itself give to you that whenever key managerial personnel insurance policy is not taxable under that PGBP, it shall be taxable under that IFOs. So there is not too much depth in this point. Therefore, I am highlighting whatever we have studied right now is the only solution, is the only meaning. Otherwise, we do not have too much depth in this topic. Sir, interest on compulsory acquisition of interest on compulsory acquisition. Sir, we have studied this in Kaplan. If our property is being compulsorily acquired, then in that case, we are being given interest on such compensation. We are being given interest on such compensation. Provision says any such interest is taxable under IFRS. Any such interest shall be taxable under that IFOS. And also a key point worth noting is, sir, we get a deduction at the rate 50% on such interest. We have studied this in other chapter. Sir, advance money forfeited, if you remember, sir, if advance money forfeited was on or after 1st April 2014, then in that case, such advance money forfeited was taxable under that IFOS. So these topics that are being highlighted in different color are to be studied in different chapters. Sir, gift taxation, sir, very, very important, sir, very important. Family pension, very important, we have to study. Salaries of MP, MLA. Sir, have you seen somebody in that white dhoti coming to your house and voting, asking for vote, begging for vote, I should say, begging for vote? That people in cap, by wearing white cap, wearing complete white kurta in the dhoti, coming to your door, calling your mother, her sister, and begging for votes. That honorable people, politicians, that honorable people, member of parliament, member of legislative assembly, whatever the money that they are getting from the government is not salary. Dear friends, whatever the money that they are getting is not salary. Whatever the money that they are getting is not their professional services, that is IFOS. It is just a volunteering work. It's just a seva that they are doing. It is just a volunteering work. It is out of no profit intention. Therefore, it is not salary. It is not profit. It is completely volunteering work. It is the remuneration for volunteering. Therefore, any salary received by any kind of MP, member of parliament, member of legislative assembly is always taxable under income from other sources. It is not salary. It is not business income. It is always IFOS income. Provision says if they receive any kind of daily allowance or contingency allowance is exempt. If they receive any kind of daily allowance or contingency allowance, it is exempt. It is exempt. It is exempt. I guess it is not contingency allowance. It is constituency allowance. Constituency. If any of the MP and MLA receive any daily allowance or constituency allowance, that is exempt. Sir, we do not have much depth in this topic. We do not have much depth in this topic. Whatever we had studied, this is the only part. Sir, undisclosed income, we have to study in the different chapter. Sir, director sitting fees. If a director receives any kind of sitting fees, sir, normally it is taxable under that salary. But if such director is a part-time director, if such director is a temporary director, if such director is an independent director, then he is not the employee of the company. He is a sitting professional. For that matter, whatever the salary that he is being paid is taxable under IFOS. If you are employee of the company, then it shall be salary. But if you are not the employee of the company, then it shall be taxable under the head. It shall be taxable under the IFRS. Compensation on termination of employment. Sir, what this provision talks about? Just listen to this. You know what? There was a clash going on between me and Riddhi madam. I hope you all know Riddhi madam, that IDT queen of our fast. Of There was a clash going on. You are not aware of this fact. I'm just telling you what happened. A few days back we were arguing. A few days back we were arguing. I want to take a power batch. She said, I want to take a power batch. I said, I want to take power batch in English. She said, I want to take power batch in English. I said, I want to take in morning. She said, I want to take in morning. Whatever I wanted to do, she was just copying me. She was not letting me teach. She was not letting me teach. I was very sad. I was very sad. That same day when I came home, there popped up a mail. A mail popped up on my mobile phone. Mail from Allen Career Institute. Allen Career Institute had given me an offer just to come and teach their leading. They were opening their branch. They were opening their branch for CS students. They wanted me to teach DT there. Oh my God. An opportunity that I cannot resign. They want me to teach. They want me to teach DT there. But when Alan asked me whether I will be able to join or not, I have to refuse this offer because I was bound. I was bound by the contract with the Sarthak sir. I was bound by the contract with the Sarthak sir. Alan said, how much will it take to break that contract? I said, 50 lakh. We are going to pay you 70 lakh rupees. Oh my God. Oh my God. Just to break the contract. Just to leave fast. Alan gave me 70 lakh rupees. Just to break contract with Sarthak sir. Just to break, just to leave teaching at fast. Alan gave me 70 lakh rupees. See, examples are arbitrary. Alan does not teach CS students. Examples are arbitrary. Numbers are arbitrary. Don't take it as personal. Take it, nothing given in these examples are true. Just take it as arbitrary examples. Sir, point is, what point is, sir, if third person is paying me certain sum to leave the employment, then such payment is taxable under IFOS. Then such payment shall be taxable under the head IFOS. And also, so since I am receiving 70 lakh and I have to pay 50 lakh rupees to Sarthak sir, taxability will turn out to be 20 lakh rupees. I will get a deduction under section 57. Did I make it very clear? Did I make it very clear? See, if I am receiving any sum, to terminate my employment, but sir, such sum shall be received from a third party. If such sum is being received from the third party, then in that case it will be taxable under that IFRS. But if Sarthak sir he himself says, I don't want you to teach TD here. If Sarthak sir himself says, I don't want you to teach TD here, provision says in that case it will be taxable under the head salary. Because if Sarthak sir is paying any sum to me, it will be taxable under that salary. We have an employee-employee relationship, therefore it will be taxable under that salary. But sir, but if such sum is being paid by the third party, then it will be taxable under that IFS. We do not have more depth than this, so I'm highlighting it as red. Any such sum which is not taxable elsewhere. Any such sum which is not taxable elsewhere shall be taxable under the head. IFOS, which is not taxable elsewhere. Not taxable elsewhere shall be taxable under that IFOS. Okay, so we got this point. So we have three color codings. Online gaming, lottery, interest, advance money, undisclosed. All these five things we will study in different chapters. Whatever have been highlighted in red are either this much only. We do not have any depth in these topics. And whatever that are highlighted in blue, we have to study in depth of these topics. Right away starting from dividend taxation. What if we right away starting from dividend taxation? Any issue till now? Any issue till now? Do you have any issue till now? Starting away from dividend taxation. So how dividend taxation works out to be? First of all, sir, we must be very much aware. So any doubt till now? If you don't have any doubt, why are you not liking the video? Why are you not liking the video? Those who will not like will get their wives will feed them with tea full of salt, not with sugar. Okay. And by mistake, most of the times when your wife is going to feed you tea, she is going to put salt instead of sugar if you will not like the video. She is going to feed you salted tea instead of sugary tea. Okay. So taxation in case of dividend. Sir, first of all, this must be very clear. Sir, dividend is always taxable in the hands of the shareholder. No tax arises in the hands of company. No tax arises in the hands of company. It is always taxable in the hands of the it is always taxable in the hands of the shareholder. Sir, are we clear with that fact? Are we clear with that fact? Yes, sir, it is very much clear. So dividend is always taxable in the hands of the shareholder. How taxation turns out to be? Sir, whenever company declares the final dividend, it is taxable in the year in which it is declared. It is taxable in the year in which it is declared. So if it is paid or not, that is not relevant. If a final dividend has been declared by the company in the AGM, it is taxable in the year in which it is declared. So we got your point. Sir, what about interim dividend? Provision says interim dividend is taxable in the year in which it is paid. In the year in which it is paid. We don't have to look for the year of declaration. So it is assumed that it is declared and paid in the same month only. So for that matter, the year in which it is declared, oh sorry, the year in which it has been paid, it will be taxable. Sir, we have a concept called a deemed dividend. We have a concept called deemed dividend, which states that these distributions might appear to be dividend, but they are actually not dividend as per Companies Act. But we assume them dividend as per Income Tax Act. See, as per Companies Act, if you read the bare provision now, dividend in India can be only in the form of cash. Meaning of dividend implies cash distributed by the company to the shareholders. Meaning of dividend is simply implied by this. So people have tried to distribute various other things just to avoid the definition of dividend and just to avoid taxation. They have tried to distribute multiple other things. So for that matter, income tax broadens the meaning of dividend. It not only includes the regular dividend, it not only includes the interim dividend, it also includes other distributions called deemed dividend. If company distributes any assets, if company distributes any liabilities, if company distributes on account of liquidation, if company distributes on account of reduction in company, if company distributes any loan, so all these distributions shall also be considered as dividend for the purpose of income tax. For companies like these are not dividends. For companies like these are not dividends, but for income tax purposes, these are considered as dividend, sir, or I can say simply deemed dividend. What provision says? Sir, for example, just think of it. Think of this balance sheet. What I'm saying. If this is the balance sheet of Rahul Private Limited, share capital is 1 crore, reserves and surplus is 4 crore, 5 crore is the balance sheet. Fixed assets or building, I should say, yeah, or I should say land. Land is worth rupees 2 crore and cash is 3 crore. Provision says if cash is being distributed by the company to the shareholder, then it is dividend. Company thought of bypassing this rule. What company did is instead of distributing cash, it distributed the land to the shareholders. Provision says we are not going to consider any distribution of the asset by the company to the shareholder shall become deemed a dividend, to the extent of accumulated profits. So to the extent of 4 crore rupees only, it will be considered as dividend. To the extent of 4 crore rupees only, it is considered as dividend. Beyond that, it is not considered as dividend. Beyond that, it is not considered as dividend. Sir, any distribution of debentures, debenture deposit certificate, debenture stock to the shareholders, or bonus to preferred shareholders shall also be considered as dividend. For example, I was the shareholder. See, for example, this is the share capital 1 crore, reserves and surplus sir 4 crore, land was 2 crore, cash was 3 crore. What company did you know? What company did? Company created a liability via named debenture outstanding and expensed it to P&L. An expense was booked against which a liability was created, which states that company has to pay 1 crore rupees as debentures to the shareholders. These shareholders were given debentures free of cost. These shareholders were given debentures free of cost. So this is directly, indirectly taking money out of the business only. This is an indirect way of taking money out of the business. So for that matter, provision says if you are distributing any debentures to a shareholder, if you are distributing any deposit certificate to the shareholders, then it shall be considered as deemed dividend. It shall be considered as deemed dividend only. Sir, if you are distributing any assets, if you are distributing any assets at the time of liquidation, then any such distribution shall become deemed dividend to the extent of accumulated profits. To the extent of accumulated profits. Not only this, if you are distributing any sum to the shareholders on account of a reduction in share capital, then also it shall be considered as deemed dividend. Sir, all these four cases, sir, any distribution shall be considered as deemed dividend to the extent of accumulated profits. So listen to this point very clearly again. To the extent of accumulated profits, any distribution of assets, any distribution of liability, or any bonus given to the shareholders, bonus in the form of debentures, any bonus deposit stock has been given to the shareholders, it is deemed dividend only. Any distribution at the time of liquidation shall also be deemed dividend. Any distribution at the time of reduction in share capital shall also be deemed dividend only. All these are deemed dividend only. Sir, we had a person named Arjun. He had a very specialized brain, trained for tax evasion, What he tried to do, see, Arjun was thinking, Arjun was thinking, share capital 1 crore, reserves 4 crore, land 2 crore, cash 3 crore. Arjun was thinking, if I'm distributing anything, everything that I distribute becomes deemed dividend. If I distribute asset, it becomes deemed dividend. If I distribute any liability, it becomes dividend. If I liquidate, it becomes dividend. If I reduce share capital, it becomes dividend. Everything becomes dividend. Everything it becomes dividend. What to do? What to do? The bottom line is, sir, dividend turns out to be deemed dividend only to the extent of accumulated profits. What Arjun did is he transferred these accumulated profits to share capital. What he did, he issued bonus. And what balance sheet turns out to be, sir, share capital now 5 crore, reserves 0, land 2 crore, share cash 3 crore. Now he started distributing. Did you see the logic? The logic behind this tax planning? How beautifully Arjun transferred the accumulated profits into capital. Arjun capitalized such profits into capital. Oh my God, sir. Arjun capitalized these profits to capital. Oh my God. Oh my God. Oh my God. Government of India says, Arjun, if you are bad, then I am your dad. Provision says, if you think you are bad, then I am your dad. What it says in all of the four sections. So whether you capitalize such reserves, then also we'll consider it as deemed dividend. If you capitalize it or not capitalize. If such accumulated profits have been capitalized into share capital, then also we will consider it as deemed dividend. Then also any such capitalization will also be considered as deemed dividend. For example, if such reserves have been capitalized in this case, provision says despite of being capitalized, 4 crore rupees of share, 4 crore of reserves shall be considered as deemed dividend, irrespective of the fact that whether they are capitalized or not. Oh my God. In all the four clauses, you will see whether capitalized or not. Did I make it very clear? So any kind of distribution shall amount to deemed dividend, but only to the extent of accumulated profits. Also point to be noted is, sir, such capitalization, such a distribution, even if even if such reserves are being capitalized, then it shall still become deemed dividend. Even if they are capitalized, they shall still become deemed dividend. Oh my God. Clear till now. Sir, the most important of all is Section 222E. I want you all to focus. So provision says that if any of the private or unlisted public company, or I should say simply unlisted company, if any unlisted company gives any kind of loan or advance, if any unlisted company gives any loan or advance to any of the shareholder who has greater than or equal to 10% of voting power, if a company gives any shareholder, if a company gives any shareholder a loan or advance, and such shareholder has more than or equal to 10% of voting power, provision says any such loan or advance shall become deemed dividend. Oh my God. Sir, if a company gives loan or advance to a shareholder holding more than 10% of voting power, provision says it shall also become deemed dividend. Oh my God. Sir, it shall become deemed dividend. Sir, what if company does not give to shareholder? Company give it to somebody who in turn will transfer this money to shareholder. Provision says this shall also become deemed dividend. If a company gives to any person on behalf of shareholder, or company gives to somebody who later on gives such money to the shareholder who has 10% voting power, in that case, money given to him shall also be deemed dividend. Oh my God. Sir, money is not being given to shareholder, money is not being given to somebody on his behalf, money is being given to a partnership firm. Provision says that if shareholder has substantial interest in this partnership firm, that means 20% or more, then in that case, any loan given, any advance given to this partnership firm shall also be deemed a dividend. Oh my God. So what this provision is all about, if any unlisted company gives any loan to shareholder, gives any loan to the shareholder who has more than 10% voting power, then in that case it shall be considered as deemed dividend. If company give any dividend, any loan to any of the person on behalf of the shareholder, or if loan or advance is being given to any or the other entity in which shareholder has substantial interest, that means 20% or more, in that case all these will be considered as deemed dividend. All will be considered as deemed dividend. My heart is crying. "Ueh, ueh, ueh, ueh." Isn't this wrong? Isn't this wrong? But that is the way how it is. We cannot do anything about this. Sir, what if company has given loan to shareholder at market rate of interest? Market rate of interest is 12%. Company has given loan at rupees 15% to the shareholder. Will it be deemed dividend? Right answer is yes, it will be deemed dividend. So shareholder repaid such loan within 1 month. Before balance sheet date, shareholder repaid such sum. Provision says it will still be deemed dividend. It will still be deemed dividend. If you have any sum that you are paying via loan or advance to the shareholder having more than 10% interest, or to some person on his behalf, or any entity in which he has substantial interest, so any such payment will become deemed a dividend. So irrespective of the fact that you have given such loan on market rate of interest, even if you have given loan on market rate of interest, it shall still be considered as deemed a dividend. Sir, accumulated profit in this case imply accounting profit. Sir, but this brings us to a situation where real life advances can also not be given. See, if company has accumulated profit, then if company is paying any advance to shareholder for any services that he is going to give, or any advance for which is ordinary course of business, then in that case, this shall also become deemed dividend. This will be wrong now. This will be wrong. So provision says three exceptions. Provision talks about three exceptions. What it says, if any advance, not loan, huh, not loan, only advance has been given to the shareholder in the ordinary course of business. So normally, if company gets any kind of services, this advance is required to be paid. So, sir, if advance is being paid to the shareholder, then it is allowed. For example, if I am required to get any technical services, I am required to pay advance to anybody. I am required to pay advance to anybody. So, in that case, if I am paying such advances to the shareholder, then it is allowed. Then it is allowed. Sir, if advance is of commercial nature, sir, it is accustomed, it is accustomed that for getting such services, for getting audit services, you have to pay certain payments. So in that case, it is allowed. It is similar thing in ordinary course of business. If I am paying advance to everybody, then I have to pay advance to the shareholder also. If it is accustomed that I have to pay advance to everybody, then I have to pay to shareholder. If such services require advance payment, and it is industry practice to pay advance payment, then in that case, if I am paying any advance to shareholder who is having more than 10% voting power, it shall not be considered as dividend. And third thing, sir, if I am paying advance to a shareholder against which I am bound to get certain services, then in that case, I am allowed to pay advance. I will not be treated. It will not be treated as deemed dividend in the hands of shareholder. So what I am saying is, if any if any loan is being given, if any loan or advance is being given to the shareholder who having 10% or more voting power, it shall be deemed dividend. But sir, in case of three advances, it will not be deemed dividend. In case of three advances, it will not be deemed dividend. What are those three advances? Provision says if advance is of commercial nature, if advance is in ordinary course of business, or if it advance in return to which shareholder is bound to give certain services, then it shall not be considered as deemed dividend. Also, we have a provision. We have a provision. What the provision is, sir? We have a provision if any buyback takes place. If any buyback takes place, then any distribution of money by the company to the shareholder shall become deemed dividend in the hands of the shareholder. So this provision is applicable from 1st October 2024. Any distribution by the company on account of buyback shall become deemed a dividend. This is section 222F. We will discuss about this later when we will study assessment of various entities. Right now, only you need to remember is as per section 222F, any distribution by the company in case of buyback will become deemed dividend. Sir, also as per section 222A, if any asset is distributed, 222C, in asset is distributed in case of liquidation, 222D, any asset is distributed in case of reduction in share capital, asset is distributed. Provision says whatever the FMV of that asset is will become deemed dividend. Sir, FMV of such asset shall be considered as deemed dividend. Any doubt till now? Any doubt till now to anybody? Are Baba, any doubt to anybody till now? Break for next 25-28 minutes. No issue if we take longer breaks. But sir, everything has to be worth it if you are able to understand things. I give longer breaks for simple reason being after break, I want you all to be re-energized. Take your time. Take your time. How long, whatever long you want to take. But whenever you come back, you have to be energized. You have to come back with same energy because whatever topic that I'll be talking, teaching after break is not that simple. It will require your emotional intelligence. So for that matter, take break seriously. Welcome back from break. Are you all back from break? Welcome back from break. Perfect. Perfect, perfect, perfect. So, sir, just before going to break, we started off with IFOS. We understood the charging section. After continuing with charging section, so we started off with taxation of dividend, where we talked about how the dividend is being taxed. Sir, what is deemed dividend and how it is being taxed? What are the complications with deemed dividend? We also discussed that point. Sir, moving further to interest taxation, how interest is being taxed. Everybody back from break? Yes, sir, we are back. Sir, how interest is being taxed? First of all, sir, interest has been categorized. It has been categorized in multiple ways. Sir, if anybody receives interest on account of loan on securities, if anybody receives interest on account of loan or securities, sir, you have to check whether giving such loan or having such securities is your ordinary course of business or not. If my business is of giving out loans, then whatever interest I will be receiving is PGBP. If my business is in dealing of securities, then whatever interest I am receiving is PGBP only. But if it is not, PGBP provision says it is IFOs. If such interest is not on account of business, if such interest is not on account of any kind of profession, then in that case it will be taxable under IFOs. Sir, if interest is on account of any fixed deposit, if interest is on account of any recurring deposit, normally it is IFOs. Normally it is IFOs. Normally it is taxable under IFOs. But sir, we must take care that if such fixed deposit, if such security deposit is necessary for conducting business, then it shall be considered as PGBP only. For example, many of the factories have a compulsion today that they have to, for getting the electricity connection, they have to deposit 10 lakh rupees as security deposit. Many of the factories that are functioning today are required to deposit certain fixed deposit initially to get the electricity connection. Provision says that that whatever security deposit that they're depositing is gives interest to them. Provision says since the security deposit is mandatory to get electricity connection, whatever interest that we will be earning on the security deposit will be PGBP only. So if FD, if fixed deposit or any security deposit is necessary for the conduct of the business, then any interest would become PGBP. Otherwise, normally any interest on FD or RD or any other savings account shall become taxable under IFOs. Okay, sir. Then we have interest on IT refund. So interest on IT refund. So whenever we file income tax return and refund is being due, refund is being due, provision says any interest on that refund shall be always IFOs, and for everybody it will be IFOs. Interest on IT refund will always be IFOs, and for everybody it will be IFOs. So normally interest on securities, interest on FDRD is taxable in the year in which it is accrued, but sir, interest on IT refund is taxable in the year in which it is received. Normally, sir, interest on FDRD loan is taxable in the year in which it's accrued, but sir, interest on IT refund is only taxable in the year in which it is received. Sir, we have certain exempt interest also. For example, if we have any interest on post or a public provident fund, it is always exempt. If we have interest on post office saving account, provision says 3,500 interest is exempt and rest is taxable. If we have joint account at post office, provision says up to 7,000 rupees interest is exempt, rest all is taxable. Interest on gold deposit bonds is also exempt. Sir, if you remember, we had started the chapter capital gain with the meaning of capital assets. I told you normally three types of assets are capital asset, out of which first one was any asset is a capital asset. It had four exceptions. Stock and trade is not capital asset, but movable personal assets are not capital assets. Rural agriculture land is not capital assets, and sir, gold deposit bonds and gold monetization certificate are not capital asset. So this is what gold deposit bond is. Sir, any interest on this gold deposit bond is exempt. It is not even capital asset, and in any interest on such gold deposit bond is always exempt. Sir, if any FD is necessary for conduct of the business, like electricity FD, if any security deposit is necessary for conduct of business, then such security deposit, interest on such security deposit will be always PGBP income and not the IFRS income. Sir, are we clear with taxation of interest? Sir, there is no point of discussion on this topic. It is very easy topic. It is very easy topic. There is no such point of discussion. There is no requirement of any discussion. Sir, income from renting of plant and machinery. Income from renting of plant and machinery. See, if income is on account of renting of house property, then it is always house property. If I am renting out house property, then whatever income that I will be receiving is income from house property only. If I am renting out anything in ordinary course of business, if I am renting out any plant and machinery, if I am renting out anything, say house property in ordinary course of business, it is PGBP. But sir, if I am renting out anything elsewhere, not in ordinary course of business, not house property, then it shall be considered as IFS. For example, if I am renting out land, it shall be considered as IFS only. If I am renting out plant and machinery, it shall be IFS only. Provision says if it is not done in ordinary course of business and if it is not house property renting, any renting will be taxable under IFOS head. So remember, whenever you get a rent on land, it is always IFOS because land is not house property. It is always taxable under IF. It is always taxable under IFOS. Sir, there is a concept of subletting. There is a concept of subletting which says if you have a flat, for example, if I have a flat on which I am paying rent of 25,000 rupees per month, and that flat has two rooms, sir, I can sublet this flat also. Provision says if I've already taken a flat on rent and I'm subletting it to somebody else, sir, that shall also be taxable under that IFRS. वो भी IFRS में जाता है. That also is taxable under that IFRS. I hope you got the point. Sir, how rent is being taxed? Sir, whatever the rent amount is, take it gross. Whatever the deductions are with respect to repairs, whatever the deductions are in respect of insurance, and whatever the extra amount is, sir, that has to be reduced. So that any expenditure that is directly attributable to earning such income can be reduced under section 57. So if you are doing any insurance, if you are doing any repairs, if you are charging any depreciation, any expenditure that is directly attributable to earning such rental income can be directly reduced from this income. Sir, am I clear with the income of renting of plant and machinery? Sir, it is very simple provision. It is not difficult provision as such. Now allow me to come to the next topic, that is taxation of gift. Allow me to come to next topic, which is taxation of gift. Sir, it is not the simpler one the way you think. And I can guarantee I will teach you in a manner that you have never ever studied before. Are we clear till now? Yes, sir. Absolutely clear. No issue. Sir, there are certain gifts which are exempt. Sir, first of all, whenever we are reading gift taxation, we have to assume ourselves to be gift recipient. Always assume yourself to be recipient. For the person making the gift, it is not relevant. Taxation of gift is only applicable for the person who is receiving the gift. Person giving the gift is not covered here. Sir, person receiving gift is only covered. Okay, sir, we got this point. Person receiving the gift is to be only considered. Sir, is to be only considered. We got your point, sir. We got your point. Sir, if I am receiving something for free, then too it shall be covered here. If I am receiving something which is at inadequate concession, then too it shall be considered here. For example, if I am receiving gold whose fair market value is 50 lakh rupees, I am receiving it at just 10 lakh rupees, or whatever benefit I am getting, that is covered in this provision. That means if anything is acquired at free of cost, it is considered as gift. If anything is acquired at a inadequate consideration, then it is also considered as gift for this provisions. So gifts are of two types. First one is exempt gift. Second one is taxable gift. First of all is exempt gift. Second is the taxable gift. Always you have to check whether gift is exempt or not. If it is exempt, then only you are going to further move with taxability. First of all, you have to check whether it is exempt or not. What all gifts are exempt? Understanding it line by line. Sir, if I am receiving only any gift on account of my marriage, if I am receiving any gift on account of my marriage, sir, it will be always exempt gift. If I am getting married, if I am getting a Rolls Royce, provision says it is exempt. If I am getting married, I am getting a gold worth rupees 2 kg. 2 kg gold I am getting, provision says it is exempt. If I am getting 5 house properties at my marriage, that is exempt. Sir, but what if in my marriage my father receives a Rolls Royce? In my marriage, my father receives 2 kg gold. Provision says it will be taxable for him. Only for the recipient who is receiving the gift in the marriage, whose marriage is occurring, that is only exempt. Any other relative who is receiving gift shall be taxable. Remember this point. If I am getting married, whatever gifts I am receiving is exempt. But if I am getting married, gift received by my father will be taxable. So this point must be taken care. Second thing, sir, if I am receiving gift from any of the relatives, sir, that shall be exempt. Sir, who is relative? We will discuss later. Third thing, if I receive any gift on account of will, if somebody is dying, most of the times he writes his will. Provision says if I receive any such assets on account of will, that shall always be exempt. Any of the person, for example, Ratan Tata died and Ratan Tata wrote in his will that every property of Tata will go to Rahul, then in that case it will be exempt in my hand. If anything I am getting on account of will, it is exempt. Sir, anything on account of inheritance, that is also exempt. Sir, for example, if any of my ancestors died and he wrote in his inheritance, or whatever property that he had has been inherited to me, provision says it is exempt. So any received on account of marriage of mine will be exempt for me. Any gift received on account of on from relative, that shall be exempt for me. Any gift received on account of will, or any gift received on account of inheritance shall be exempt. So any gift due to death of the donor or pay is exempt, sir. Need not to stress this topic. Sir, if I am receiving any gift from local authorities, sir, if I am giving, sir, see, I am getting clean roads, I am getting water supplies. So this is not less than sort of gift. Provision says if I am getting any kind of gift from local authority, it is always exempt. Sir, provision says if we have any kind of trust which is registered under section 12 AB, or if we have any hospital or institutes which are registered under section 1023C, if they receive any gift, or somebody receiving gift from them, then it is not treated as 56 to 10. It is not treated as gift under section 56 to 10. So remember this point. If trust is receiving any money, if trust is receiving any asset at a lower consideration, it is not treated as gift to trust. If trust is giving a benefit to somebody, if trust is paying some benefits to poor, so it is not treated as gift in the hands of the poor. So remember this thing. Trust is meant for the public welfare. So whenever trust receives something at a lower price, it is not gift for him. If trust pays anything, if trust gives any benefit to any poor, then it is not gift gift in the hands of the poor. Sir, you can skip this part. Taxation in case of COVID, sir. Already it has been 5 years to COVID, and these provisions are already obsolete. These provisions were applicable for 12 months from the end of the year in which COVID occurred. So this all period have lapsed. So you can skip this point. You can skip this point related to COVID. Next point. Next, or I should say last point is, sir, for example, Rahul creates a trust, donates some money to it, and that trust is meant for benefit of my relative. Benefit of my relative. That trust is meant for the benefit of my relative. Then in that case, now whatever money that has been received by the trust is exempt. Whatever the money that has been received by the trust is exempt. Sir, need not to stress this topic. This is not the area which is frequently asked in exam. If we look at the analysis of what has been asked in exam, IFOS has been the least preferred area by the examiners, at least at CA final level. It has not been asked very frequently. Now, who is relative? Sir, what I told you, sir, there are certain exempt gift. Any gift on account of marriage is exempt. Any gift on account, any gift received from relative is exempt. Any gift received from will or inheritance or on death of the donor is exempt. Any gift from local authority is exempt. And we said any gift received by trust and received from trust is always exempt. So now what matters is the definition of relative. Sir, I want all of you to have attention at least for next 2 minutes because this definition of relative is very important, very comprehensive. Sir, if you misunderstand this meaning, it will be difficult for me to cover the other topics. This definition will be referred again and again in later topics. Sir, if there is an individual, for him who are relative, for him what all people are relative. Sir, for an individual, his spouse is relative. For an individual, his spouse is relative. His spouse is the relative. For an individual, for an individual, his lineal descendant are relative. Lineal descendant imply, sir, son, son's wife, daughter, daughter's husband, grandson, granddaughter. These are relative. Lineal descendant. For individual, his brother is relative, his sister is relative, his brother's spouse, his sister's spouse is also relative. For an individual, his spouse's brother and their spouse, spouse's sister and their spouse is also relative. Whenever I'm talking about brother, it also includes spouse. Whenever I'm including any sister, it also includes spouse. Sir, for an individual, his mother, father are also relative. His mother, father are also relative. Provision says any brother of mother and their spouse, any sister of mother and their spouse are relative. Any brother of father is also relative. Any brother of any spouse of father's brother is also relative. Any sister of father is also relative. Any husband of sister or father's sister is also relative. Okay, we got this point. Brother, father of both mother and sister are relative, and their spouses are also relative. If I have parents, then parents are relative. Brother and sister of any of the parent will be my relative, and their respective spouses will also be my relative. Sir, for me, my spouse's mother, father will also be relative, but their brother, sister will I will not take account. I just need to make sure brother, father, oh, sorry, brother, sister of my mother, father can be included. Sir, if I have any lineal ascendant, that means grandmother, grandfather. If my spouse has any lineal ascendant, that is grandmother and grandfather, they shall also be relative. Can you see this picture? Can you see this picture? If I am just asked to draw this again, can you see a kind of animal in this picture? Can you see a kind of animal in this picture? What kind of animal or insect or reptile you can see in this picture? What kind of picture? What kind of animal? What kind of reptile you can see in this picture? Can you please just tell the name? Can you just guess the name? Can you guess the name of this reptile or this animal? Sir, it kind of looks like a mouse. It kind of looks like a mouse. Hmm. It appears to be mouse. Sir, what to do? You have to remember. Whenever I am referring to relative under section 56 student, you have to remember mouse. Sir, how mouse? Sir, for any individual, he is his spouse is a relative, his lineal descendant are relative. For any individual, his spouse is a relative, his lineal descendant are relative. For an individual, his brother, sister are relative, and their respective spouses. For an individual, his spouse's brother and sister are relative, and their respective spouses. For an individual, his mother, father are relative, and their mother, father's brother, sister, and are relative, plus their respective spouses. For an individual, his spouse's mother, father are relative. For individual, his LA, LD are relative, LA lineal ascendants are relative, and for an individual, his LA spouse's grandfather, grandmother are also relative. We have to remember this mouse whenever I am referring to relative under section 56 to 10. Whenever I am referring to relative under section 56 to 10, you have to remember this mouse. You have to remember this mouse because this mouse is going to make you remember every relative that has been covered under the section. So, sir, if I receive gift from any of the relatives, if I receive a gift from any of the relatives, sir, it will be exempt. It will be exempt. Sir, I am asking one question and all of you have to answer. Asking one question, you have to answer what I'm asking. Sir, for example, I gave gift to my father's brother worth rupees 2 lakh. See, in this case, I am gifting an asset to my father's brother. I am giving an asset to my father's brother. Sir, will it be taxable in his hand or will it be exempt in his hand? My question to you all is if I am giving any asset to my father's brother, father's brother, will that be taxable in his hand or will that be exempt in his hand? Waiting for your answer. Arjun says taxable. Right answer is it shall be taxable. Sir, why so? Just think of it that way. Sir, for example, I am giving to my father's brother. Sir, gift taxation is always to be assumed from the viewpoint of recipient. Just think of an uncle. From whom he is receiving gift? He is receiving gift from his brother's son. He is receiving gift from his brother's son. Is my brother's son covered? Right answer is no, sir. My brother's spouse is covered, but my brother's son is not covered. So I'm receiving a gift from a third party, not from my relative. Therefore, for my uncle, for my father's brother, it will be taxable. But if I receive gift from him, it will be exempt in my hands. See, it is not always the two-way relationship. Absolutely correct, Arjun. Absolutely correct. Well done. Well done. Sir, once relatives definition is done. Acha. For any HUF, any member of the HUF is the relative for HUF. Any member of the HUF is relative. Now we have taxability of gift. Sir, whenever a gift is not exempt, whenever a gift is not exempt, it shall be taxable. Sir, first, for example, if I receive money as a gift, if I receive money as a gift from Arjun, I am getting 25,000. From Shweta, I am receiving 25,000. If I'm receiving 25,000 from Seelam, if I'm receiving 25,000 from Monisha, provision says if I am receiving money aggregating to 50,000 or more, aggregating more than 50,000 rupees in a financial year, then whatever money that I am receiving will be taxable under IFOS. If I am receiving gift individually from somebody, if I am receiving gift in cash individually from somebody, individual or aggregate, if such money in the financial year exceeds 50,000 rupees, then such money shall be taxable in my hands. Remember, if I receive money as a gift from anybody, if I receive money as a gift from anybody, then such money received shall be taxable in my hands. If such money exceeds 50,000 rupees in a financial year. Okay, so we got this point. We got this point. Sir, provision says if I get any movable property, for example, somebody is gifting me their shares. Somebody is gifting me their shares. Provision wants to know whether fair market value of such shares exceeds 50,000 rupees. If fair market value of such shares exceeds 50,000 rupees, then in that case it will be taxable in my hands. Whatever the FMV is will be taxable in my hands. Also, sir, if I am being getting shares at a lower cost. Many times I don't get assets at free of cost. I get assets at a lower cost. For example, we have Arjun with us. Arjun sold shares of Reliance to me for rupees 1000. Market value of such shares is 1500. So this is the benefit only. Now I am getting 500 rupees per share for, let us assume, 1000 shares. I am getting benefit of 5 lakh rupees. Provision says if I acquire any property at a less than consideration, at a consideration less than FMV, then whatever the FMV minus consideration amount is will be taxable in my hands under 56 to 10. Whatever the inadequate consideration that I am paying, sir, FMV minus consideration shall be taxable if it is exceeding 50,000 rupees. In our case, since FMV minus consideration is 5 lakh rupees, since difference is exceeding 50,000 rupees, then this shall be taxable. This shall be taxable. Entire difference shall be taxable. Oh my God. Oh my God. Sir, yani I cannot, this implies I cannot take any movable property as gift. I cannot take movable property as gift. Right answer is yes, you cannot take movable property as a gift if it exceeds 50,000 rupees aggregate in a financial year. Oh my God. Oh my God. Sir, can I take any immovable property as gift? Provision says if aggregate immovable property, nah, sir, not aggregate. If value of immovable property exceeds 50,000 rupees, or I should say, if stamp duty value of property exceeds 50,000 rupees and you're getting it for free, then provision says stamp duty value shall be considered as gift for you. If you are receiving any property whose stamp duty value exceeds 50,000 rupees, then it shall be considered as gift. Sir, a very important point to be seen, a very important point to be seen. Sir, cash is considered in aggregate. Whenever I receive cash from one person, second person, third person, aggregate cash during the financial year is considered. Whenever I am considering movable property, sir, like shares, I am considering jewelry, whatever movable property that I am considering, sir, that shall be taken in aggregate. But for every immovable property, you have to check property wise. You don't have to aggregate the properties. For example, if I am getting property from Arjun worth rupees 20,000 rupees, immovable property, I am getting a land worth rupees 20,000 rupees free of cost. If I am getting land from Shweta at rupees 25,000 rupees, if I am getting land from any third person at rupees 25,000 rupees, even though in aggregate immovable property exceeds 50,000 rupees, it shall still not be taxable. Why? Because for immovable property, you have to check the property. You have to check the details of every property. For cash, you have to check for aggregate. For movable property, you have to check for aggregate. But sir, for immovable property, you have to check property wise. For movable property, you have to check the property wise details. Sir, we got this point. We got this point. Sir, what if I did not receive property for free, but I received a property for an inadequate consideration? What if I received a property for inadequate consideration? Provision says if difference exceeds 50,000 rupees, if difference exceeds 50,000 rupees and stamp duty value is greater than 110% of consideration, then whatever the difference is, you have to pay taxes under 56 to 10. Difference has to be more than 50,000 and stamp duty value exceeds 110% of consideration. So then difference is taxable. Then difference is absolutely taxable. Are we clear how taxability takes place? If I am getting cash, if I am getting cash exceeding 50,000 rupees in a financial year from anybody, it is taxable in my hands. If I am getting any immovable property aggregating to 50,000, aggregating to more than 50,000 rupees in a financial year from different person, then it shall be taxable. At last, provision says if I'm getting any more property from anybody whose I'm getting for free of cost, whose SDV exceeds 50,000 rupees, then that property shall be taxable. Sir, in this case, in case of property, you don't have to do aggregate. You have to check per property wise. Sir, if you are getting property at a lower cost, you are getting property at inadequate consideration. Provision says in that case you have to check whether SDV exceeds 50,000, whether SDV of the property exceeds 50,000 rupees. Sorry. If you are getting it for lower consideration, you have to check whether SDV minus consideration exceeds 50,000 rupees. And sir, and SDV exceeds 110% of consideration. If both the conditions are satisfied, then difference shall become taxable under IFOS. Is it clear? I'm waiting for you all to respond. Is it clear? So we got your point. We got your point. Now, sir, certain important points to be considered. Certain important points to be considered. Sir, what are those certain important points? Sir, provision says, sir, for cash, you have to check limit of 50,000 rupees. If you receive cash, then whatever, then it will be taxable. Then complete cash receipt during the year will be taxable. If you receive movable property during the financial year up to 50,000, then it is exempt. But if you receive more than that, then it shall become taxable. So provision also gives a condition that if cash plus movable property received during the year in aggregate exceeds 50,000 rupees, then also it shall become taxable. Yes, sir. Sir, if movable property during the year is up to 50,000, if cash is up to 50,000 rupees, but in aggregate, if they both exceed 50,000, then too it shall become taxable. Oh my God. See, you have to check limit for cash individually. You have to check limit for movable property individually, and then you have to check limit for both of them collectively. That means in collectively, cash and movable property together shall not be more than 50,000 rupees. If they exceed 50,000 rupees, then it shall be taxable. Oh my God. Oh my God. Sir, what if I am receiving cash of rupees 20,000 rupees and I am getting shares at a lower cost and benefit is 50,000, 40,000 rupees? Provision says benefit is 40,000 now. Benefit from shares is 40,000, cash is 20,000, aggregate is 50,000. Then in that case, it shall still become taxable. Oh my God. Oh my God. You have to check you have to check in aggregate for cash and movable property also. Sir, we got this point. We were not aware of this fact, but we got it today. Arey, you are already aware. You are already aware. Second point that is worth noting is, sir, movable property does not imply every movable property. Only 10 or 9 securities, 10 or 9 assets are covered in this movable property, which are only taxable under 56 to 10. Not all assets are taxable, only a few assets. Only a few assets are taxable under 56 to 10. What are those? Sir, provision says if you have any kind of shares acquired free of cost or acquired at a lower consideration. If you have any kind of securities, if you have any kind of jewelry, if you have any kind of painting, drawing, sculpture, archaeological collection, any other form of art, if you have any kind of bullion or if you have any kind of virtual digital asset, any of such asset, if acquired for lower consideration or if acquired for free of cost, shall become taxable if it exceeds 50,000 rupees. Again, I'm repeating. Any kind of shares, securities, drawings, paintings, sculptures, archaeological collection, any other form of art, bullion, virtual digital asset, jewelry also. Any kind of shares, securities, jewelry, drawing, painting, sculpture, archaeological collection, any other form of art, bullion, virtual digital asset. Again, shares, securities, drawings, paintings, sculptures, archaeological collection, any other form of art, jewelry, bullion, and virtual digital asset. Any of the asset, if received during the year, exceeds 50,000 rupees. If asset value 50,000 exceeds, or if difference exceeds 50,000 rupees, then it shall become taxable in your hands under 56 to 10. So if I'm receiving a car, then it is not taxable. If I'm receiving car for free, it is not taxable. If I am receiving, so if I'm receiving, for example, a mobile phone, it is not taxable. If I'm receiving watch, it is not taxable. So if I'm receiving a bike, it is not taxable. Only these 10 assets are covered which are taxable, otherwise no taxability will come. Only these 10 assets are taxable, otherwise no taxability will come. Did you get this point or not? Did you get this point or not? Did you get this point or not? Yes, sir, we got this point. That means movable property imply only 10 securities. So shares, securities, joint paintings, sculptures, archaeological collection, any other form of art, jewelry, bullion, or any other virtual digital asset. Any virtual digital asset. Only these 10 securities are covered under 56 to 10 movable property. Every other property that you receive is not taxable. Okay, sir, we got this point. So also another third condition. So first condition we studied that you have to check aggregate of cash and movable property. Second condition we studied what is immovable property, and third condition is, sir, whenever you receive anything as a gift, whenever you receive anything as a gift, that should be capital asset for you. Means, sir, whenever I am receiving, for example, a land, and that land I am receiving either for free of cost or either I am getting at a very subsidized cost, at a very low cost than FMB or SDB. So such land, if it is held as capital asset for me, then only it is taxable under IFRS. Sir, for example, if I have a business of trading in lands, then in that case, I am bound to buy land at lower prices. Now, then in that case, gift provision do not apply. If I buy things at a lower price, if I buy things at a lower price in my ordinary course of business, so it is my business only not to get things at a lower price. In that case, in that case, gift provision do not apply. For example, I am a gold jeweler. I am bound to buy gold at a lower price now. So for that matter, sir, whatever benefit I am getting is not taxable under the gift. So that means bottom line is that gift provisions will only apply if I hold such property as if I hold such property as capital asset. If I hold such properties as stock in trade, then in that case, gift provisions do not apply. Do not apply. Sir, for example, if I receive shares of Yes Bank, see Yes Bank a few years ago was under reconstruction scheme. Reconstruction scheme because Yes Bank was about to be dissolved. Yes Bank was about to be closed. So for that matter, to revive the Yes Bank, government put a bid so that people can invest more in Yes Bank, capital can inflow more in Yes Bank. Private banks shall also participate in reviving of Yes Bank. So for that matter, the prices of shares of Yes Bank were very much slashed out. People bought Yes Bank at a very subsidized prices. So for that matter, whatever subsidized prices they got on reconstruction or revival of Yes Bank is not gift provisions as. If you buy shares of any company or shares of subsidiary of subsidiary company or shares of any subsidiary, then in that case, sir, it will not be considered as gift if company's board of director has been suspended under section 242. See, if you have a company whose board of directors being suspended, then if you buy shares of such company, if you buy shares of subsidiary of such company, if you buy shares of subsidiary of such company, in that case, 56 to 10 will not apply. You are bound to buy shares at a lower price than FMB because ultimately management is corrupt. So for that matter, if you are buying shares, it will not be considered as gift. Sir, for example, if government is statistically disinvesting a public sector undertaking, if I buy such shares at a lower price, provision says it is no benefit given to us, it is not gift. And at last, if I get any kind of car, mobile phone, wristwatch, it is completely exempt because it is not considered as movable property in itself. Sir, are we clear with the gift provisions? Are we clear with the gift provisions? Sir, if we are clear, then we have to proceed further with taxation in case of immovable property. Taxation in case of immovable property. That is going to take a bit while. Just let me know. Are we clear till now? Yes, sir. Absolutely clear. Yes, sir. Clear. See, for a person, listen, for a person selling any immovable property, see, our discussion will be strictly restricted to immovable property. Our discussion will be strictly limited to immovable property. Okay, if I have immovable property, if I have immovable property and I sell it to somebody, if I have immovable property held as capital asset, then capital gain will arise. If I have immovable property held as stock in trade, then PGBP will arise. Simple provision. If I have any kind of immovable property and I sell it, sir, capital gain will arise in case of held as capital asset. If I sell such property and holding it as stock in trade, then in that case, PGBP provisions will apply. Sir, basic provision it is. Yes, sir, we got this. If I am the recipient of the property, if I am recipient of the property held as capital asset, so 56 to 10 will apply 56 to 10. But if I am recipient of the property and I hold such property as stock in trade, then no 56 to 10 will apply. No 56 to 10 will apply. Sir, let us understand this with an example. You will enjoy this example. You will enjoy this example. I want your sincere participation in this example. Sir, for example, this is Rahul Satija. And this is Shraddha Kapoor. If you are aware of her, beauty queen Shraddha Kapoor. Sir, no relatives. Rahul has a property held as capital asset. Okay. Rahul gifts such property. Gifted property to Shraddha at zero cost. For Shraddha also it is capital asset. What will be the taxation implication in the hands of Rahul? Sir, fair market value of the properties. Yeah, stamp duty value of the property is 1 crore. Provision says if I am gifting this property to Shraddha, it is held as a stock capital asset for me, it is held as capital asset for Shraddha only. In that case, what treatment will apply? Sir, for me, there will be no capital gain. No capital gain will arise because the section 47 clearly states that if an individual transfers any kind of asset under the gift, it is always exempt. If I gift anything to anybody, sir, it is exempt in my hands. If I transfer any gift to anybody, it is exempt in my hands. Yes, sir, it will be completely exempt. It will be completely exempt. No capital gain will arise under section 57. Under section 47, yes, sir, under section 47, no capital gain will arise. Sir, for Shraddha, who is receiving this property at free of cost, shouldn't there be applicability of 56 to 10? Shouldn't there be applicability of 56 to 10? Why, sir? Because ultimately it is capital asset for her. She is receiving assets for free of cost, and sir, SDV exceeds 50,000 rupees, and difference of SDV and consideration also exceeds, SDV exceeds 110% of consideration. SDV exceeds 110% of consideration, and difference is also greater than 50,000 rupees. Then in that case, this should be taxable under 56 to 10. Written says yes, it will be taxable. This was the case 1. Case 2. Same case. Rahul and Shraddha are not relative. I gifted her property to Shraddha at rupees 20 lakh rupees. Fair market value of the property is 100 lakh. What will be the treatment in my hands? I want all of you to respond. I want all of you to respond. What will happen in my hands? What will happen in my hands? Let's see how much in depth you can think. How much in depth you can think. Sir, if Rahul is transferring any immovable property whose SDV exceeds 110% of consideration, and transfer is also not exempt. So in that case, capital gain will arise in the hands of Rahul. and stamp duty value shall be considered as full value of consideration. This is considered as per 50C. As per 50C. Sir, 1 crore full value of consideration shall be taken minus cost of acquisition. Sir, capital gain will arise in the hands of Rahul. And sir, for Shraddha, what will happen? Shraddha, since Shraddha's, she is getting a benefit. Cost for Shraddha is 20 lakh rupees. SDV is 100 lakh rupees. In this case, difference of 80 lakh rupees is exceeding 50,000. Also, SDV is greater than 110% of consideration. Then in that case, 80 lakh will be taxable under section 56 to 10. Are we clear with this point? Yes, sir, we are clear with this point. Beautiful, Arjun. Changing things a bit. Sir, if Rahul held such asset as stock in trade and gifts such asset to Shraddha, then what will be the tax treatment in the hands of Rahul and what will be the tax treatment in the hands of Shraddha? Sir, very simple it is. Very simple it is. For Shraddha, since she is receiving a capital asset and she is receiving free of cost, whatever the FMV of that property is 100 lakh rupees or whatever the SDV of the property is 100 lakh rupees, 100 lakh will be taxable under 56 to 10. Sir, for Shraddha, since it is capital asset, 56 to 10 will apply, and sir, in that case, whatever the FMV of the property or SDV of the property, that shall become taxable in her hands. For Rahul, if he is giving free, can I section 47 will apply? Can I say section 47 will apply? Right answer is no, sir. This will not be exempt transfer. Even though Rahul is giving for free of cost, it will not be considered as exempt transfer. Why? Because for Rahul, it is not a capital asset. Na? For transfer to be exempt, you must have assets which are capital asset. You cannot claim exemption on You cannot claim exemption on stock in trade. No, sir. You cannot claim exemption of exempt transfer in stock in trade. Sir, you cannot. Sir, for a person who holds such securities as stock in trade, provision under section 43C apply, which is as good as section 50C. Talks everything similar to section 50C. It says if any person who has sir immovable property as a stock in trade, in that case if he sells sir any property in which SDV exceeds 110% of consideration, in this case SDV will become consideration, or sir SDV is lesser than or equal to 110% of consideration, so in this case actual consideration will be full value of consideration, sir. That is how PGP will be calculated. Whatever we had said in 50C, it applies as it is under section 43CA. So in this case, since Rahul is transferring for free of cost, sir, 43CA will apply and it will be taxable under the head PGBP in the hands of Rahul, taxable under PGBP. It will be taxable under the head PGBP. We got this point. For Shraddha, it is taxable under 56 to 10. No issue whatsoever. Similar relation. Again, it is stock in trade for Rahul. This is fourth adjustment, fourth point. Rahul gifted that property at 20 lakh rupees. Fair market value 100 lakh. Sir, if I have a stock in trade and I am giving such stock in trade at a very low consideration to anybody, I am giving such stock in trade to a low to anybody at a low consideration. Am I allowed to do that? Right answer is so as per section 43 CA. Whenever I transfer and SDV exceeds 110% of consideration, so we have to ignore the consideration and we have to take SDV as your PGBP. For me, PGBP provisions will apply. And for Shraddha, sir, no change because she has capital asset. No change because she has capital assets. Sir, whatever benefit that she is getting, sir, 80 lakh rupees shall be taxable under IFOS. Fifth point, sir, similar transaction. But transaction here is for Shraddha, it is stock in trade. What treatment will turn out to be in this case? I want all of you to answer. Rahul and Shraddha are not relatives. For Rahul, it is capital asset. For Shraddha, it is stock in trade. Rahul transfers such property at completely free of cost. What to do in the hands of Shraddha? What to do? What to do in the hands of Shraddha? Sir, Rahul has capital asset. Rahul has capital asset. Sir, if we are transferring any capital asset for free of cost, then can I say it is gift given to him? And since it is gifted given to him, it is exempt in the hands of Rahul as per section 47. Yes, sir, it is exempt as per section 47. This is exempt in the hands of Rahul. Shraddha is acquiring stock at free of cost. Sir, will there be any treatment if she holds such property as stock in trade? Right answer is there will be no tax treatment. And sir, why no tax treatment? Sir, but because sir, why no treatment? Because for a property to be taxable in somebody's hand, it has to be a capital asset. If it is stock in trade, then provisions will not apply. Provisions of this gifting will not apply. Provision of PGBP will apply. Oh my God, PGB provisions will apply. Yes, sir, PGBP provisions will apply in this case. And sir, it is reasonable now for a businessman to acquire property at a very less prices or free of cost. It is reasonable now. They are sitting there to do business. For that matter, they have to acquire properties at a very low cost. So for that matter, if they acquire any property at free of cost, no taxation will apply. So this means we are it is a option for tax planning. There is an option for tax planning. Right answer is no. Ultimately, when Shraddha is going to sell this property, she has to offer full value of consideration, whatever the sales price is, and cost of acquisition will become zero in this case. Cost of acquisition will become zero in this case. This implies whenever Shraddha holds such property as stock in trade and she receives any property of free of cost, no treatment. So we got your point. Beautiful, beautiful, Arjun. Similar question, sir, similar question. Again, Rahul and Shraddha are relative. For Rahul, it is capital asset. For Shraddha, it is stock in trade. I transfer such property for rupees 20 lakh and FMV will be 100 lakh. Sir, for Shraddha, no treatment will change, no answer will change because since Shraddha has a stock in trade, whatever the purchase price she pays will be the final purchase price. There will be no adjustment in purchase prices. So for her, cost of acquisition will be 20 lakh and no tax treatment. No tax treatment will apply. Okay, sir, we got this point. No tax treatment will apply. But sir, if for Rahul, who is holding such asset as capital asset, he is transferring such assets at 20 lakh rupees fair market value. Fair market value of such assets were is 100 lakh rupees. In that case, sir, section 50C will apply, and sir, he has to offer SDV as full value of consideration. Seventh point, sir, no extra points for guessing. Sir, for Rahul and for Shraddha, it is stock in trade. It is stock in trade. If it is stock in trade for both of them, Rahul is giving it away for free. Shraddha is receiving it away for free. What will be the tax treatment for Shraddha? No tax treatment because it is presumed that whenever you buy properties at a least possible price or free of cost. But if you are holding stock in trade and you are selling stock in trade at free of cost, sir, 43 CA will apply. 43 CA will apply, and in that case, sir, whatever the SDV of the property is, you have to take it as full value of consideration. Point number 8. Again, for Rahul and for Shraddha, it is capital asset. Sorry, it is stock in trade. Sir, property gifted to property at 20 lakh FMV, 100 lakh. What treatment will happen in the hands of Shraddha and Rahul? Sir, for Shraddha, whatever the purchase price paid is 20 lakh will become cost of acquisition. No other treatment. For Rahul, what will be? Sir, 43 CA will apply. Sir, SDV, that is 100 lakh, will become full value of consideration or business receipts. That is how things go in case of immovable property. That is how things go in case of immovable property. Sir, any doubt till this point? Sir, whatever I had told you, shouldn't we draw a summary table for this? Shouldn't we draw a summary table for this? Okay, sir, we can draw the summary table. Sir, for example, if I am the transferor, that is Rahul, and I hold such asset as capital asset, and if I give it for free, then in that case, sir, section 47 will invoke no capital gain. If I have that capital asset and I am giving it for inadequate consideration, then in that case, section 50C will apply. SDV will be taken as full value of consideration. If I have stock in trade, sir, whether I give it for free, whether I give it for inadequate consideration, sir, every time section 43CA will apply. For transferee, if it is held for capital asset, whether she receives for free, whether she receives for inadequate consideration, sir, section 56 to 10 will apply. If she holds such asset as stock in trade, whether she receives for free, whether she receives for inadequate consideration, in both the cases, sir, no treatment will apply. This is the crux of the topic that we had studied till now. And sir, this crux has already been incorporated in your book. Your book is after incorporating such adjustments. Such beautiful, beautiful pointers are already inculcated in your book. You need not to worry at all. Another important section. Another important section. What it says. Sir, whenever I am giving a property to Shraddha and she holds such property as capital asset, not stock in trade, but she holds such property as capital asset. Sir, what will be the cost of acquisition for her? What will be the cost of acquisition? See, for example, if I am gifting property to Shraddha, for example, FMV of that property, Rahul gifted such property to Shraddha. FMV was 100 lakh. Cost of acquisition was 20 lakh. Sir, whenever Shraddha decides to sell such property for 200 lakh rupees, what will be the cost of acquisition that she is going to reduce? Is it going to be 100 or 20? Is it going to be 100 or 20? Is she going to reduce the actual cost or is she going to reduce the paid purchase price? What will be the provision says? If transfer is not on account of exempt transfer, sorry, if transfer was not assessed to tax, that means in case Shraddha has not been taxed under section 56 to 10, if on Shraddha no tax provision has been applied for exempt gift, so this gift was exempt for Shraddha. This gift for exempt for Shraddha. So there was no tax implication. So when will no implication will apply? So if Shraddha receives such gift on account of marriage, if Shraddha receives this gift from brother Rahul, then in that case, this transaction was not taxable. And if this transaction was not taxable, then you have to take cost of acquisition of previous owner. If transaction was not taxable under 56 to 10, then you have to take the cost of acquisition of previous owner. But if this transaction was taxable, then you have to take the FMV or SDV on which you have already paid taxes. That in that case, 100 will be taken. So cost of acquisition is dependent upon whether the transferee, whether Shraddha has paid taxes under 56 to 10 or not. If she has not paid taxes, then cost of acquisition of previous owner will be taken. If she has if she has been taxed under 56 to 10, then whatever the FMV or SDV on which she has paid taxes will become cost of acquisition. So is this point really very clear? Is this point really very clear? Yes, sir. We got this point. Sir, next taxation is family pension. How family pension is being taxed? Just understand this point. See, what is family pension right now? Normally, nobody receives the family pension. Otherwise than army people. Only those who are in army receive family pension, or the people who joined into government services prior to 1st April 2000, 1st April 2001 receive family pension. Or if somebody is contributing to pension fund, they are receiving family pension. Sir, what is family pension? Understand? Sir, absolutely clear. Absolutely clear. Sir, what is family pension? See, if a person retires, whatever money that he will be receiving after retirement is the pension. It is considered as salary only and it is taxable in the hands of the person who is retiring only. But as soon as he dies, for some time, for some period, his family is being given certain some money every month. What I am saying is, sir, if after retirement, if anybody is receiving any sum, it is considered as salary only. It is considered as the whatever pension received is salary only. It is taxable under the head salary. But if person dies and family member receive pension in instead of that person, then in that case it is family pension. Provision says it is taxable under income from other sources. Say normally pension is taxable under salary head. But if somebody died and you are receiving pension on his behalf, that is considered as family pension. Family also receives certain pension in case of many employees. So in that case, whatever family pension that family members are receiving is considered as family pension. It is taxable under it, income from other sources. Also, against this family pension, a deduction is being allowed. A deduction under section 57 is allowed. Sir, what is the deduction? It is one third of family pension. Whatever the family pension is, take one third, or sir, 15,000 rupees per annum, whichever is lower. One third or 15,000, whichever is lower. But you have to take make we have to make sure that if assessee opts for IXO 115 BAC, if assessee opts for 115 BAC, then in that case this 50,000 limit will become 25,000 for those who pay taxes under 115 BAC, whichever is lower. So what amount of deduction that we are going to get on family pension? First of all, sir, one third of the family pension. Second of all is 15,000 per annum, whichever is lower. But if SSC is opting for 115 BAC, then this 15,000 limit will turn to be 25,000. So this might be asked in your MCQs. I really speculate this point might be asked in your examination. This has not been touched by anybody. Therefore, if nobody touches this point, ICI does. Sir, if somebody who is the recipient of the Paramveer Chakra or Veer Chakra and their family member receive any kind of family pension, then it is exempt. If recipient of Paramveer Chakra or Veer Chakra, their family members receive any family pension, it is exempt. Sir, if any person, if any officer who was into armed forces, who was into paramilitary forces, sir, he died and his widow or children receive any family pension, then it is exempt. If any officer of armed forces, if any officer of paramilitary forces dies and his widow wife or his children receive any family pension, then it shall be exempt. Section 57. I don't know how many times Section 57 has been asked in an exam. Complete chapter kept aside, this 57 in itself has been asked in number of times. Number of times total IFOs has not been asked versus this 57 has been asked way more than times. Way more than times the other IFOs has been asked. So what is this section 57? Just understand this one by one. Expenditure deductions allowable. If you are earning any income which is taxable under IFOS, if you are earning any income which is taxable under the IFOS, you are given a choice. Provision says you are given a choice. If you incur any expenditure to earn that income, if you incur any expenditure to earn that income, you can claim it as deduction. Sir, for example, for earning rent, I have to pay any insurance. For earning rent, I have to do some repair expenditure, it is allowed. For earning interest, I have to pay interest, it is allowed. For earning interest, I have to pay commission, it is allowed. For earning something, sir, I have to pay some commission, it is allowed. Sir, for subletting, I have to pay certain rent, it is allowed. Sir, whatever directly attributable expenditure is for earning the IFOS income, it is allowed. So we got this point. Second thing, sir, if we get any kind of interest on compulsory acquisition of property, If our property is compulsorily acquired and we get interest on such compulsory acquisition, then provision says 50% of such expenditure is deductible. Only 50% is taxable. Third point is the most important point. The most important point. Sir, if you earn dividend, sir, in dividend can be interim dividend, dividend can be final dividend. Dividend can be for foreign company, domestic company, public sector company, private limited company, one person company. Dividend can be deemed dividend. Deemed dividend under section 222A, B, C, D, E, F. Any kind of dividend that has been earned, normally no deduction is allowed. No deduction against dividend income. No deduction against dividend income. Interest. To earn dividend, then interest paid is allowed up to 20% of dividend. Whatever the 20% of dividend is, you are allowed. But remember, sir, while considering the limit, do not take dividend from buyback. Sir, whatever the dividend that has been received on account of buyback shall not be considered. Any deduction will not be allowed. My audio video is clear now? Audio video is clear now? Yes, sir, it seems clear. It seems clear. It seems clear. Sir, how things will work out? How things will work out? For example, if Rahul has received a dividend, interim dividend 1 lakh, final dividend 2 lakh, deemed dividend 1 lakh. Out of this deemed dividend, sir, 222A was 40,000 and 222F was 60,000. And interest paid is 3 lakh. What is the amount of deduction that I'm going to get is do total 4 lakh. Reduce the 222F. That means, sir, 3.4 lakh is the taxable. So sorry, dividend taxable is 4 lakh only. But deduction will be allowed on 3.4 lakh into 20%, or interest paid, whatever the interest paid is 3 lakh, 68,000 or 3 lakh, whichever is lower. So 68,000 deduction I will be getting. 20% of the dividend amount shall be allowed as deduction. 20% of the dividend amount shall be allowed as deduction. That must be taken care. Also, sir, another important factor, sir. This question was asked in May 25 examination. Just I want you all to be attentive at this point of time. Sir, for example, this is Rahul. Earned dividend from TCS 1 lakh. Interest paid to earn dividend 30,000. Dividend earned from Infosys 1 lakh. Interest paid 15,000. In this case, how much deduction will be allowed? This was asked in May 25 examination. This was asked in May 25 examination. How much deduction will be applied? Sir, first of all, dividend will be taxable at the rate 2 lakh. Dividend taxable will be 2 lakh. For the purpose of deduction, we have to take 20% of dividend. Sir. Deduction is interest paid of 20% of the dividend. Sir, should I do total dividend? Should I do 20% of total dividend? That is 40,000 rupees. Or take it or interest paid 45,000 rupees, whichever is lower. Or should I do individually? Sir, 20% of 1 lakh, that is 20k, for which I paid 30k. So 30 lakh with 30k, sorry, 20k will be allowed. 20% of 1 lakh, that is 20k. I paid 15k, so 15k will be allowed. In total, 35 will be allowed. Sir, what should I do? I have an option. I have an option to either go for total dividend and take 20% and take total interest and compare. I have an option of going to individual dividend. I have an option of going towards individual dividend system. What it means, take dividend from one company, take out 20%, take out interest paid for earning that dividend, compare it. Take out dividend from other company, bring out the 20% of it, compare the interest paid for it, whichever is lower, take 35,000. In this case, answer will differ. In both the cases, answer will differ. If you take the total approach method, take total dividend, take 20%, take total interest, whichever is lower will be allowed. In this case, answer will differ from when you calculate answer on individual dividend system. I am asking you what should be the correct answer. What should be the correct answer? I am asking you all to answer what should be the correct answer. You have both the approaches. You can take total dividend from all the companies and take 20% and interest paid of total dividend, whichever is lower. Or you have an option of claiming individual dividend system. Whatever dividend received from company, take 20% minus or interest paid, whichever is lower. Take dividend from another company, take 20%, take interest, whichever is lower. For every individual dividend, you can do that, which is more logical to be done. Which is more logical. According to you, which is more logical? Sir, there comes a fight between. This brings us to a fight between logic and practicality. Logic and practicality. So logically, this seems correct, but practically, it is unviable, na? So ICAI does what ICAI does. What ICAI does, sir? What ICAI does? ICAI corrects this. ICAI corrects this. In suggested answer of ICAI, both the answers were corrected. If you have attempted If you have attempted the first one, then also it was correct. If you have attempted the second one, that means if you have followed the total asset system, then too it was correct one. ICAI has corrected both the answers. If you have followed any of the method, ICAI has awarded marks. That is how you can solve any of the method. You will be awarded marks without an issue. So this is not the easy thing that I can discuss. To be very honest, so this is the thing that has to be discussed in Safal batches, regular batches. But aim of this batch is not just to read the concepts, let your brain think yourself. No, if you are paying fees, then things are meant to be made simpler. Things are meant to be studied in depth. But if it is only possible when you cooperate. Otherwise, I could have easily read the provision, I could have easily told the synopsis, and I could have easily moved forward. I can easily complete this batch in 10 days only. But I have asked 17 days just to go into the depth of this topic, which is required in examination. Just imagine if somebody wouldn't have read this topic, even though he would have got this answer corrected, but he would have panicked in exam. He would have panicked in exam. If whatever answer he would have written in exam, that might have been correct. That might be correct. But sir, think of the panic that he might have had in brain while attempting the question. What to do, what to do, what to do, and I see what to do. Because of which other answers might have suffered. So you got to have conceptually strong. You got to be conceptually strong. And that is what the aim of this batch is. It's not just a batch where I just come and revise you all the concepts. I go deep into the concepts. Sir, we got this point. We got this point, sir. Sir, certain conditions to be met for making the deduction allowable. See, whenever you are doing any expenditure for any IFRS income, make sure that expenditure should not be personal expenditure. Sir, if you are making any payment, if you are doing any expenditure on which TDS is required to be deducted, if you are making any payment on which TDS is required to be deducted, provision says, deduct TDS, otherwise 30% or 100% of that expenditure will be disallowed. Provision says if you are making any payment, sir, comply 40A3. Any payment account via any payment should be done via account paycheck, account by demand of electronic credit system. Otherwise, you should not make any payment as such. Sir, no expenditure shall be allowed against the casual income. Sir, if you are earning any kind of lottery income, online gaming income, any expenditure done on such income shall not be allowed. At last, sir, no expenditure shall be allowed against the income which is referred under section 222F. Sir, if you are having any kind of buyback income, any kind of income which is taxable under 222F that is considered as deemed dividend from buyback you are not allowed any expenditure against that income. So there was case law relating to Manju and company. What happened was there was SSC who used to sell lottery tickets on commission basis. Who used to sell lottery tickets on commission basis, or his business was to sell the lot and earn the commission. Provision says one day Manju and company what they did now, they were unable to sell certain tickets. They were unable to sell 10 to 12 tickets. And what happened is, out of these remaining 10 to 12 tickets, they earned the lottery. They won the lottery of 5 crore rupees. See, businesses to sell the lottery and earn the commission. They could not sell all the tickets, therefore some tickets were left out, and they won lottery out of that leftover tickets only. Now, what argument Manju and company did that they wanted to claim this income as PGBP income because they thought that it is their business to sell lottery. Manju and company argued that since it is our business to sell lottery tickets, this income should be our business income. This should not be casual income. Whereby Kerala High Court gave a judgment. Kerala High Court said that even though, despite of the fact that it is your business to sell the lottery, but your business is to earn the commission. Winning lottery is not your business. Winning lottery is not your business. Winning lottery is a game of chance, game of luck. It is not skill. Therefore, whatever winning that you have earned is casual income. It will be taxable under IFOS only, and it will be taxable at 30%. No deduction whatsoever against such income. That completes our IFOS topic. Let's come to question answers. Sir, two question answers. Achha, one question from this frame and company. One question we have done. Prem is a partner of firm X and company. We have done this question while calculating the 45.4. We have done this question. The same question is in our concept book. Also, we have done this question. This Manan question we can only do after non-resident taxation. This after carry forward of losses. Income from other sources. Come to this question. Mr. Hari, a property dealer, sold building in the course of the business to his friend Rajesh. Hari sold property to Rajesh, who is a dealer in automotive. See, Hari has a business of dealing in property. He is a property dealer. And Rajesh is automotive dealer. Sir, his business is to deal in automotive parts. He sold the building for rupees 90 lakh rupees. When stamp duty value was 150. Oh my god, sir, consideration is 90. Sir, stamp duty value is 150. Gee. The agreement was entered on 1/9/2023 when stamp duty value was 130. Hari had received a down payment in cross check. Sir, on agreement date, the seller received down payment in cross check. Sir, that implies seller did not receive any payment. Any payment received on cross check is cash only. You have to receive money via account paycheck, account by demand of electronic clear system. Any other medium is not considered as payment. So for that matter, SDV on the date of registration, that is 150, shall be taken for the purpose of capital gain computation. Discuss the tax implication in the hands of Hari and Rajesh. Assume that Hari has purchased this building on 75 lakhs. Sir, Hari had purchased this building for 75 lakhs. Selling it for 90 lakh and SDV is 150 lakh. Sir, Hari is a property dealer. So section 43 CA will apply. In this case, sir, stamp duty value shall be taken as full value of consideration. Cost of acquisition is 75 lakh rupees. Whatever the gain is, sir, that shall be taxable under the head PGBP. That shall be taxable under the head PGBP. Also, Sir Rajesh is receiving a property whose SDV is 150 and receiving just at 90. So, sir, difference is exceeding 50,000. 60 lakh, of course, is more than 50,000, and also SDV is greater than 110% of consideration. Then, in that case, sir, that difference is taxable under 56 to 10. Sir, another point, would your answer change if Hari was a share broker instead of property dealer? If Hari was a share broker, sir, will my answer change? Right answer is yes. Only change will be, sir, instead of section 43CA, sir, provisions under section 50C will apply. Only change will happen, that is, instead of PGBP, there we will have short-term capital gain. For Rajesh, there will be no change. Manju Menon, just listen to this question. This is a good question. This is a good question, Manju Menon. Sir, Manju Menon is a assessee in Coimbatore holding 20% in private company called Aurelia. Sir, Manju Menon is a person holding 20% in Aurelia Exports Private Limited. Assessee has immovable property in Coimbatore. It was let out to the said property. Sir, Manju had a property which is let out to the company. Okay, no issue. Assessee permitted the company to provide the said property in a collateral to ABC Bank in order to enable the said loan from the said company. Consequently, property was mortgaged to the bank. The time board of director passed a resolution authorizing the assessee to obtain the loan, interest-free loan and deposit up to 20 lakh rupees. As and when required, available the said property as collateral to the bank for the loan facility enjoyed the company. In June 2024, Manju Menon asked for advance rent, received 15 lakh rupees and company advanced the rent. It was rent per month was adjusted against the rent payable by the assessee for the said to the said company. After said adjustment during the previous year, the amount of advance rent stood reduced to 8 lakh rupees. Accumulated balance was 10 lakh rupees. Assessing officer treated such as a deemed dividend and can advance given by the company to the Manju Menon shall be treated as deemed dividend or not. Oh my God, sir, what this provision says? Read it one by one, understand it one by one what it says. Sir, assessee is Manju Menon and we have a company called Aurelia Exports Private Limited. Assessee has a property that is being given to Manju Menon, that is given to Manju Menon property, and in return Aurelia Exports gets monthly rent. Assessee has also given a power. Manju Menon has also given a power to this Aurelia Exports that whatever the property that they have given, Aurelia can use this as mortgage. Whenever Aurelia wants loan, they can mortgage this property with the bank and take loan. Just imagine, I have a property and I am giving this property to the company and also giving a right to the company that in case company wants loan, company can mortgage this. Just imagine if company fails to repay the sum, my property will be gone. Just in case I am giving my property to the company and the company is not able to repay the loan, my property will be gone. So I should have some securities now. So for that matter, Board of Director of Aurelia Exports Private Limited passed board resolution that whenever Manju requires, company will give unconditional loan of 20 lakh rupees. Company will give unconditional loan of 20 lakh rupees. See, I am giving my property and I am allowing you to get that property mortgage. If you are not able to pay, my complete property will go. I am taking a risk now. So for that matter, I want something in return. So board of director passed and post the board of director passed a board resolution that company can give you unconditional loan. Company can give you unconditional loan of 20 lakh rupees as and when required. Manju Menon did not even exercise the loan, did not take the loan. On 1st June 2024, what Manju Menon did is it asked for advance rent. It just said, just give me advance rent. Advance rent. 15 lakh rupees. Just give me advance rent. I don't want any loan. Just give me advance rent. And sir, every month, whenever rent is due, I will adjust from this advance rent. Every month, whenever rent will become due, I will adjust from this advance rent. Provision says as on 31st March 2025, she has already adjusted 7 lakh rupees of advance rent from the rent due. Now, whatever outstanding balances, sir, 8 lakh is the outstanding loan or advance that has been given by the Aurelia to the Manju Menon. Assessing officer just had a look on this. Assessing officer found out that 8 lakh rupees advance has been given to Manju. 8 lakh has been advance given to the Manju, and sir, accumulated balance is 10 lakh rupees. Assessing officer treated this 8 lakh rupees as deemed dividend. Sir, we have studied this point that if a company gives any loan or advance to a shareholder holding more than 10% of voting power, that shall be considered as deemed dividend to the extent of accumulated profits. But sir, in our case, if we are giving any if we are giving any money to Manju, that is on account of services that company is getting now. Ultimately, if company wouldn't have paid this money, wouldn't have they paid this money, then Manju wouldn't have given collateral. Manju wouldn't have given such property as collateral. So it is directly or indirectly we are getting a service from the shareholder. Then only we are giving that property. Then only we are giving this advance rent. This advance rent is not by will. It is not a gratuitous advance. A word is being used in the answer. It is not a gratuitous advance. This is not a kind of gifted advance. Sir, company is getting some services against this advance. Company is getting some services in this advance. So this will not be considered as deemed dividend. Sir, it was even said by the High Court in case of Pradeep Kumar Malhotra. Pradeep Kumar Malhotra. If you can remember the case law, well and good. If you cannot remember, no issue whatsoever. It is not in the nature of gratitude to advance. Therefore, such advance rent shall not be treated as income. That complete your income from other sources. That's all from for today. That's all from today. Most probably you will not have tomorrow we will not have any class. We'll have class day after tomorrow. That shall be on YouTube. We will start the topic PGBP. We'll try to cover the most of PGBP tomorrow only, day after tomorrow only. If something left, we can continue on Tuesday. We are going at an absolutely good pace. You need not to worry about it at all. And believe me, the level of conceptual clarity that we are having now is unmatchable. Whatever time that people used to take in capital gain, whatever revision videos that you might see on YouTube are only for, I guess, 3 hours. Maximum revision video available is 3 hours, but we have covered such capital gain for at least a 6.5 or 7 hours we have taken, or not less than 8 hours actually. First day, 2 hours of capital gain. Second day, 4 hours of capital gain. Today, 2 hours of capital gain. 8 hours we have given that topic. So it is way more than revision. It is way more than revision. We are also covering the question answers. So guys, believe me, have trust in yourself that whatever we are studying is sufficient. It is sufficient for clearing examination. All you need to do is now just trust me. Come regularly in class. Come live. Do interact with me whenever I ask any query from you all. Do interact with me whenever I ask any query from you all. And the most important is, sir, as soon as the class is over, do complete the question answers. Today, it's your duty to complete all the question answers of capital gain, all the questions answers of PGBP. You have to complete it by today only. Otherwise, sir, things will get piled up. I hope you are getting. Sir, we got your point. We got your point. We absolutely, absolutely, absolutely got your. So, guys, that's all from my side today. If you really like the teaching, do think of subscribing to this batch. Also, if you think that live session really benefit you, do bring at least one friend with you. Do bring at least one friend with you because it will help to fulfill purpose of this batch, purpose of this live batch. Otherwise, I could have only gone for recorded batch, but since student wanted live batch, I came up with live batch. So thank you so much. You all have been wonderful, wonderful students today. Thank you so much for coming live and enjoying making the session more lively ones. Bye bye. Take care. Enjoy Sunday. Have a great day. Have a great festival. See you guys on Monday with same energy, excitement, and enthusiasm. Signing off. See you, Rahul Satija. Many thanks for watching.